years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues. Chinese stocks listed in the U.S. suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
Hello, I'm Shonali Bassick, Bloomberg's Wall Street correspondent. On behalf of Bloomberg, I'm so pleased you can join us on the second day of Bloomberg Invest Global. The economic effects of the pandemic have changed the financial landscape, and today the markets are still volatile. There are fee pressures and low interest rates. But amid all of the uncertainty, we know there's opportunities, and our terrific lineup of guests are here to help you spot them. Before we get started, a few tips to help you get the most out of your event experience. If you experience any issues with audio or video quality, try to refresh your browser or use the chat box in the bottom right corner of your screen for support. You'll be able to submit questions during the interviews. We hope you do. To submit a question, please click the white tab on the right side of the video window. And if you note your name and geographical location, we'll give you a shout out. While we may not get to all of you, we'll try our best. And please engage with us on social media. #BloombergInvest. You can engage with the other attendees in the event chat box at the right corner of your screen. I'd also like to take a moment to acknowledge our U.S. presenting sponsor, Invesco QQQ. Our presenting sponsors, Abu Dhabi Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, Letter One, and Qatar Financial Center. And finally, our supporting sponsor, CMC Markets Connect. And now we kick things off with a focus on Southern Africa's recovery. In this session, we'll ask, can privatization drive growth?
I'm Francine Lacqua, and I'm delighted to be joined by Vera Davies de Souza, the Finance Minister of Angola, to talk about the country and, of course, the prospects for the future. So, Minister, thank you so much for joining us this morning.
It's my pleasure. It's my pleasure to be here with you, Francine.
Minister, the government is planning to ask for a new IMF program once the current program ends at the end of the year. Is that so?
Francine, we are evaluating our options. We are discussing with the IMF team and within the government which options we have after this program to end. We are looking to the pros and cons of moving with a program or only with technical assistance, or only with the surveillance under the Article 4. We are evaluating all these options, and before the end of the year, we will have a clear vision of which way we will follow.
So, Minister, how will you actually decide? Is there a certain criteria? Is it a matter of how expensive or how cheap it will be, or is it other factors taken into account?
It's more a matter of which solutions match better with our actual needs. We are evaluating what are our circumstances now and which shape of cooperation, because we still want to work together with IMF. It's a matter to understand which kind of engagement we will have.
Minister, what is the government's growth forecast for 2021?
We are expecting a stagnation, zero growth, but we are seeing the oil productions performing worse than that we are expecting. So let's see if we will have a recession again. Hopefully not. At the best scenario, stagnation. At the worst scenario, a slight negative growth.
Do you expect the recent increase in oil prices to have a positive impact on spending, though, and overall economic growth in Angola?
the two effects works together: the increase on the oil production and the decrease on the increase on oil price and the decrease in oil production. Let's see how they will work together and what will be the final result of it in the growth. Regarding the expenditures, we need to keep being as more conservative as possible to create a buffer, but for sure we need also to take care of buying vaccines is something that we need to expend some money, and also make sure that the projects that are near to an end, that we are able to pay them to have these infrastructures available to our population. Those are our three main goals regarding a potential buffer that we will create with the difference in between the oil price.
What are you expecting in the price of oil going forward? At the moment, we see huge energy price surges across the world. This could be also, lead to some kind of economic shock. From where you're looking at it, what does it look like?
This market is so volatile that is difficult to foresee a movement, but we are seeing a lot of advanced economies with high rates of vaccination, the economies starting to recover. So probably we will see a market where the price will keep a trajectory that it's not so low, but a price above $60 or $70 per barrel probably is something that it's not impossible. But I don't think that this movement of high prices will take so long. So for the countries that are oil producers, that they need to keep their focus and still being conservative despite this high movements that we are seeing, because I really do not believe that we will see a price for so many times higher than $80 per barrel. So we need to do our maths counting on a more conservative price. And this is what Angola intend to do, because we already start preparing our budgets for 2022, and we will be as more conservative as possible, defining the oil price that we will use as reference for our budget.
Minister, Moody's also on September 13th raised its rating for Angola for the first time since 2015, citing improved governance and prompting the nation's Eurobonds to surge and yields to drop. Given the improved outlook and lower funding costs, are you considering selling Eurobonds this year or in 2022?
That was great news for us. We are truly happy with that. We saw the results of the hard work that we are doing regarding the structural reforms that we are implementing, regarding the proactive debt management that we are putting in place, the fiscal consolidation, the free float regime on the exchange rate. So we did it a lot in very difficult circumstances. So we are happy that Moody's recognized all this package of reforms and measures, upgrading our rating. For sure, we are evaluating the best moment to move on and to issue Eurobonds is something that was out of our agenda, but with this in short term, out of our agenda in the short term. But with this upgrade, we are now looking again to it, to understand the best moment to go to the market in the short term. So it's something, yes, that we are evaluating.
And at this point, do you think that it would make more sense this year or to wait a bit?
It's the decision that we need to take and we will also ask the opinion of the IMF, because we have the program till the end of the year, and we will ask them their opinion about the best moment to go, if even this year or only the next year. So we are discussing internally, and we will also count on the technical assistance of IMF regarding this matter.
Do you know the size of how much you want to sell already?
Not yet. We will depend on our fiscal space. We do not want to do something that is more than that our ability to still being totally confident about our debt sustainability. So we will consider also this, and probably because of this, next year would be better than this year. But we are analyzing, and we will decide this as soon as possible.
Minister, but you're confident that there's enough demand for these kind of products? And again, does it make a difference if there's a second IMF program attached to it? Or, as long as there are guarantees or something like that, you think appetite for those products will be the same?
For sure, the markets and the international community will always be more confident if they know that we're still working with IMF. It's a fact. This is a fact, and we are aware of it. Because of this, we want to keep working with the IMF, not only because we want to attract the interest and the interest of the potential investors, but because we truly believe that the working with the IMF, the cooperation with them is really useful, and we are seeing the results and the effects of it in our macroeconomic indicators. So it's our own interest to keep working with them. What we need to define now is how we will work together. And for sure, at the end of the day, the reflex would be in our own economy, and our figures, our numbers, and our performance will talk to itself. And the international markets will understand that we're still committed to get the best performance as possible in our economy.
Minister, Angola has also been carrying out very ambitious privatization program that includes the sale of stakes in some of the country's actually biggest companies, including state-owned oil company Sonangol, the diamond company, and Diama. Has this privatization program so far succeeded in attracting foreign investors to Angola?
Yes, more local than foreigners. But we are seeing a lot of international interest, especially when we are talking about inviting the investors to manage the assets. Regarding buying the assets, we are getting less interest. But when the contract is to manage an asset for a period of time, with the option of buying it off after this period, we are getting a lot of interest coming from abroad. So we already privatized 41 assets. So we are happy. For sure, we could do more, but we are doing it in a moment where all the economies start recovering. So we are not seeing so much liquidity, and doing this through this moment, I think it's quite remarkable. We still 97 assets to sell or to contract hired management, and we intend to do it in the next 1 to 2 years. And we really expect that with the international recovery of the economies, with more people being vaccinated, and with this upgrade also from Moody's, this is something that also counts regarding the interest and the confidence of the investors. Probably we will see more offers coming, and also the price the final price of selling those assets being more positive for us.
Are there any concrete examples, maybe of foreign companies interested in potentially investing in Angola?
Yes, we saw it. We saw it on some farms. We saw interest coming from Latin America, and at the end of the day, a Latin America entity buy a farm to explore. We saw interest coming from South Africa for a local bank. And a bank that was totally state-owned, and is something that is moving. We didn't saw the final result yet. It was a public tender. And we saw also interest coming from Europe for an insurance company. The process was not finalized yet. For a huge supermarket with different stores, we saw also interest coming from Europe. So yes, we are seeing some good examples, and let's see if the final result would be good for both parts.
Angola is also scheduled to hold general elections next year. The current president is expected to run. So is the government preparing, Minister, to announce big spending projects ahead of the election, as has been the case with previous elections in 2017 and 2008?
Angola is huge, and we have a huge lack of infrastructures. We are always trying to do as much as possible, as quicker as possible. Of course, we can do much more when we have fiscal limits, when we have small revenues, when we have small capacity of get more debt. So it's not easy to see people needing to get access to electricity, to water, to roads, and we are not being able to provide this. So it's not an easy task. So as soon as we see the financial condition improving, we try to do more. If the financial conditions do not permit us to do so, we need to do less. So it's a matter of money available to do the infrastructures, and not really a matter of elections, in my perspective. So with the oil price increasing, let's see what will be possible to do next year. If we see a movement against us, we will need to shrink the budget, and that would be the reality that we need to deal with.
But is there a risk, or do you perceive a risk, that these elections can actually derail your ability, the finance ministry's ability, to continue to cut spending and repay debt to creditors?
That's always a pressure. As Minister of Finance, I used to say that I'm not properly the most, how I say in a good way, I'm the no woman. The no woman.
You keep the purse strings.
It's not easy to say no all the time. So I need to manage this, the balance in between get things done and the importance of also protect our indicators and avoid the fiscal deficits. So I'm always managing that pressure coming from all over the places. I will keep doing my best to defend our budget, our fiscal accounts. The pressure will never end. As I mentioned, the country is huge, and that's a lot of needs, a lot of expectations. The Angolan people are waiting for so many years for getting the best access to social services. So it's not easy to resist. Each day is a difficult day to move with the velocity that do not harm too much our account. I will keep doing my part, and that God help me through this path.
Minister, finally, when you look at the pandemic over the last 18 months, what do you need from the world economy now to make your job a little bit easier? Is it getting better, or are we still really in the middle of the storm?
We're still in the middle of the storm because we are not being able to vaccinate the people as quicker as we should. Because of a lot of factors, but the first one and the most important one is the access to vaccines. It's quite hard to have access to them, to buy them in quantity that it's good enough, big enough for our population, and also at a good price. So it's a difficult equation, but we'll keep seeking it. We will keep knocking all the doors to get that access to the best price as possible. And while this do not happen, we will need to manage with the measures to sometimes close more the economy and ask to close some services. The tourism is suffering a lot because of that, but we need to do it to avoid that. We save as much lives as possible.
Minister, thank you. Vera Davis de Souza there joining us today. And Bloomberg Invest Global continues. Please stay with us.
Looking for an advantage? Explore a country starting an exciting new chapter where business reforms have created new opportunities. A land full of potential and a young workforce. Where manufacturing has global ambitions. Be part of Africa's growth story. Advantage Angola.
Hello and welcome to this 5-minute spotlight session on the investment environment and opportunities in Angola. Today I have the honor of speaking with Dr. Antonio Enriquez da Silva, who's the Executive Chairman of APEX, Angola's Investment and Export Promotion Agency, as well as with Mr. Otoniel dos Santos, who is the Secretary of State for Finance and Treasury of Angola. My first question is for you, Antonio. Angola has registered a total of 396 investment projects from August 2018 through to July 2021, budgeted at $4.2 billion US. What do you think is behind the recent increase in investor interest in Angola?
Well, first of all, thank you very much for this opportunity to share our Angolan story. And I will begin by saying that they are mainly due to the ongoing reforms, especially to the political ones, and not only because the impact of the political ones had was a major boost to all the other reforms that are on the economical side. And having said that, we also had strategically in place a set of programs directed to diversification of our economy that have improved the level of participation of investors. And also, we also noticed that from the existing set of investors, they had switched from trade and other services to a more risky kind of operations within the manufacturing sector. And that has given us a strong sign to investors, foreign investors, that Angola, as part of the reforms and as part of the anti-corruption campaign that's been driven by our government, has improved the kind of assurances that investors seek into a new market. And Angola also has a strategic position in the continent, and the infrastructure that is being built will enable us to not only play a role as a country, but also to be part of a much broader setup within the African continent.
Wonderful. And Secretary Otoniel, one of the perceived risks of investing in Angola has been the shortage of foreign currency in the country and the issues that that can cause. How is the government responding to this, and what guarantees are in place for investors thanks to the new investment law?
Thank you, Nikki. Thank you very much for having us. Like any other countries, Angola economy has suffered from the shock of COVID pandemic, but not only because we were recovering from the shock on oil prices. All those elements brought to us a lot of challenges that authorities had to tackle, implementing some strong measures on the public health, fiscal one, debt sustainability, and also monetary policy measures. On the monetary policy measures, we had one specific one, which is very important for us to be to make guarantee to international investors, which is since 2018, a new foreign currency law or approach was implemented by the central bank, the one who allowed more diversified players to bring and to buy and sell foreign currency in our market. Also, one of the main important measures that was taken by the central bank was implementing a new platform to trade the currency in the country, which is the Bloomberg FX Go, and there are a lot of players playing in this buying, selling in this platform, such as oil companies, also diamond companies, and even the treasury make a deal in this platform. So we believe that this brings a lot of transparency on the price, everything what could be sold, and also bring some more confidence to the investors. On the other hand, having said that, this is there is something that is also important, is that the opening of an international account by the central bank for those who want to make investment through the exchange, I would say the stock market, brings more confidence to those investors that could come in and step out whenever they want.
Wonderful. I think we've run out of time. I do have one more question. Will we be able to edit if we get a bit more footage? I'll go ahead and ask it. Antonio, my last question is, talking about Angola's privatization program, ProViv, why is this an exciting opportunity for international investors? And what would your message to the global investment community be watching today?
Well, we are talking about a set of strong, let's say, companies within our market that are with a consolidated business, that the KPIs of those companies can be compared as to any other market that is undergoing a privatization program. And of course, due to the diversification program, we believe that it's a great opportunity for investors to look at. And of course, we are not only foreseeing that though the privatization program itself as an opportunity, but all other opportunities that in Angola are open for investors should be addressed. And right now, creative conditions do allow investors to have the kind of confidence and outlook that they search in a market. And of course, Angola is not an exception, and we welcome all of them to visit and implement investment projects in our country.
Thank you very much. So I think we've finished.
I would like to comment as well on that question about privatization. I don't know if I have time. I know that we run a little bit out of time, but just maybe a few seconds.
Is it okay to carry on?
To this session on driving a successful privatization program in sub-Saharan Africa. Sub-Saharan Africa, as you know, urgently needs more dynamic private sectors, and their renewed vigor for privatization in the region in particular. Angola in Southern Africa is pressing ahead with an ambitious program that aims at transferring the ownership of at least 190 state-owned enterprises to the private sector. And the government expects the program will help generate local jobs, boost sustainability, and trigger quicker economic growth. Key to this success will be transparency, policy certainty, and political stability, as our panel will discuss. And indeed, in this session, we will discuss privatization and investment in Southern Africa. We have with us today an excellent panel to share their insights from decades of experience and help us understand privatization in this exciting region. We have Kevin Giraini, who is the Regional Director, Southern Africa and Nigeria at the International Finance Corporation. Peter Van Welzen, a Senior Consultant, Financial Markets Africa with CMS in South Africa. And Sunita Kekere, who is a World Bank veteran of more than 3.5 decades. And Sunita, if I am just to start with you, could you help us set the stage with how far privatization has come in Africa?
Okay, thank you very much, David. I've been at the bank for so long, and we began tracking privatization transactions in all regions of the world, and then especially in Africa at one stage. And in the region, it started in the late 1980s and the early 1990s. And by 2000 or so, we had tracked well over 3,000 transactions that had taken place in the region. Transactions were mostly concentrated in a core set of countries. This included Mozambique, Angola, Ghana, Zambia, Kenya, Tanzania, and Guinea. So that's where most of the activity was happening at that time. These were relatively small transactions in early years, but over the years down the line, they opened up to more complex SOEs and opened private sector participation in focus on private participation in infrastructure. In terms of example, in Nigeria with the port concessions, Tanzania and Ghana, the sale of telecom shares, share sales in Kenya, Rwanda, and South Africa. In most SOEs, however, or in most countries, the SOEs continue to operate in virtually all sectors of the economy, including manufacturing and services that had long been designated for privatization. So sales were announced, but often they were not ever concluded. I think the process played out over the 1990s and the 2000s, but to me, there was a turning point when the global financial crisis hit in 2008. And that's where there'd already been a lot of rumbling about, negative rumbling about privatization. And that was the turning point where there was a swing away from privatization to more of a renationalization approach in some countries, and more of a shift to corporate governance and private sector participation in enterprises rather than full outright privatization through management contracts, leases, concessions, and so on. So now I think the bank, just before I left, the bank had adopted the MFD approach to privatization, which is maximizing finance for development. And this is something that now is being applied across different countries in Africa and also around the world. The aim of this MFD approach is basically to leverage all sources of finance expertise and solutions to focus on sector reforms, basically to improve the enabling environment, build capacity, and establish standards and find ways to find first innovators and movers. So overall, I think we've come a long way in this privatization debate. So we've seen so many different approaches that have been put in place that have led to the spectrum of solutions, public and private solutions. We've incorporated global lessons and also addressed equity and affordability issues through many of these projects, and basically seen that there's to be, going forward, a mix of public and private funding to meet development needs.
Thanks, Sunita. And it looks like indeed a lot has changed, except the one single thing, which is it is still an emotive issue. And I'm sure we'll discuss this a little bit later in the conversation. But I want to bring in Kevin. From your experience, could you tell us what has worked and what hasn't? And here, feel free to bring in examples from across the continent.
Thank you, David. I'll say that at a macro level, privatization has worked, particularly if we keep in mind that governments turn to privatization as part of the economic reform program, as Sunita was saying in the 80s and 90s, to revive economies and spur growth. And so in the face of the success of privatization, I would say a number of countries have sought better ways to partner with the private sector, to leverage their capabilities in financing, and in the latter years to public-private partnerships, or PPPs, especially in regulated sectors. To be more specific, I'd say early wins were recorded in the telecom and the electricity sectors. These are examples in which private sector participation was preceded by robust regulatory reforms and sector liberalization, which successfully attracted the private sector players. The infrastructure is a good example of where the private sector can really drive change. And if you think about it, you have 600 odd million people in Africa who still don't have power, over 300 million people who don't have access to clean water. And broadband reaches probably less than 0.5% of the population. And so I would say a recent example of where we've seen the private sector play a valuable role, I'd say, is in the energy sector, specifically through the World Bank Group's what we call the Scaling Solar Program. I'll give you 2 examples. In Zambia, the Scaling Solar Program made it more affordable for Zambia to pursue solar solutions. And this lowered the risk for solar providers seeking to enter into this new market. In Zambia, we've had 2 solar PV plants launch operations just this past year, and they will provide energy at one of the lowest tariffs for electricity in Africa, which also helps reduce CO2 emissions. I would say another sector is telecoms, and this is where we have seen the private sector play an important role in rolling out digital infrastructure and services to more people. This will include whether it's setting up communications towers, fiber cables, mobile networks. And the recent case of Ethiopia is one which I think many of us will be familiar with. In last year, in 2020, the government of Ethiopia asked us as IFC to advise on the structuring and tendering of 2 telecom licenses. And in May of this year, the government awarded the first competitively tendered license to the highest bidder. I think this resulted in the government receiving an upfront fee of over $800 million. And while the money is substantial, I think it's beyond the money. We can look at the benefits that the project is expected to bring. I would say the liberalization is going to help connectivity to the most vulnerable communities. It can enable them to have access to digital services, for basic services like education and health and emergency, and also access to information, remote working, which all of us are very familiar with in the pandemic now, and e-government services and so on. And so I would say that, it definitely has helped. And I think the cascade approach is how can the private sector bring solutions first before encouraging the government to come to the fore?
Thank you, Kevin. And the Ethiopian story, of course, is one that we are really, really closely watching as a frontier market. But let's zoom in on Angola, which, as we know, is put up many assets for sale and a privatization. And if I'm to ask you directly, Kevin, I mean, the Angolan government is looking to diversify away from oil. It's looking to, grow jobs. It's looking to accelerate its economic growth. Will this work? We've seen it, in places, Nigeria and elsewhere. But for Angola, if we're to ask you a question, how will privatization bring about growth as a channel?
I would say it will make a difference. When we think about it, there are many aspects that they're looking at. I mean, the country has over 195 state assets, and the idea is to tender this across all the sectors, including the financial sector, industry, agribusiness. energy, transport, financial services. And so there's a lot that is being done. But in terms of just will it bring growth directly? I would say yes. And if you think about it, one of the advantages is that let's look at the growth inhibitors, right? So privatization helps alleviate the distortions and efficiencies of SOEs, as Nisha said earlier. I think another consideration is that privatization can raise funding to settle the debts of accumulated SOEs. And many investors, not just in Angola, but many countries, do have huge amounts of debt. And so by bringing the private sector, it can free up the fiscal space for growth and development. We have seen many committed governments, and we know that the Angola government is committed, put in place private sector enabling environments by reforming sector-specific institutional, legal, and regulatory frameworks. What has also been good to see is governments adopting transparent processes for service delivery and engaging with multiple stakeholders to drive private sector-led growth. And so, to meet the needs of developing countries, we need to preserve the constrained private resources by bringing the private financing, which I think is what Angola is doing. We see the private sector designing sustainable business models to support financial inclusion, promote trade, access to internet, and so on. And so by bringing in all these new investors, it allows the government to use the resources to be directed to other areas. And so as we have seen, not just in the Angola case, but also in the Ethiopia case, we can bring on board best international practice. We can facilitate fair and transparent entry of the private sector, which can enhance the quality of service across a myriad of sectors and change millions of lives. And so in a nutshell, yes, we're confident that it is going to work.
International practice indeed when you're dealing with, international investors. Peter, you have worked on many of these deals. You have actually worked on Angola and elsewhere. A simple question, is Angola's plan feasible?
Well, I think if you look a bit at the proof is in the pudding, then I think it's interesting. Perhaps also good to note that the number of, let's say, privatization projects has been reduced somewhat. Some have been added, some have been. So I think there are about 140 now. But I think that around 40 have already been successfully completed. So I think if you look at it from that perspective, then yes, it's certainly a feasible kind of plan. I think what you have seen, I think, is that in particular, let's say the smaller assets have been used first actually for the process. So there are still, let's say, quite a lot of interesting larger assets to come. And I think also Kevin already mentioned, I think it's the financial services sector. It's quite predominant. Also, I think the telecom sector is present. And I think what we should also recognize is that it's a bit of a mixed bag. So in some cases, it's just a couple of percentages of shareholdings that are being offered. In others, it's like a full 100% holding. In some cases, there are joint venture partners that still need to be convinced that the Angolan government should step out. And so there's a bit of a number of things that still need to be sorted out. I think one important aspect, I think, and if you compare that perhaps to, let's say, some of the, let's say, more traditional privatizations, is that it does not really include, let's say, very critical assets like utilities. Water, electricity are not. I mean, there are some crown jewels there like Sonangol and Diama and TAG, but these are already companies that have, let's say, have a kind of a more commercial function. So I think from that perspective, is it going to be feasible? I think the feasibility will need to show in the end in the result. And I think that's probably, in particular with the larger assets, that's going to be quite interesting to see how that will work out.
And thanks, Peter, for mentioning some of the crown jewels. Sonangol, the national oil company. We know many investors are excited about that one. But I mean, Peter, you spend every day at work talking to these investors. Could you tell us the reputation of African assets in the eyes of these investors? How do they price these assets? How do they look at them? And while you're at that, could you also tell us where this capital is going to flow from? Are we going to see, IPOs? Are we going to see money parachuting in and just, paying off government and picking up these assets? Could you give us some more details on how this is going to be playing out?
Well, if I look, let's say, like focusing a bit on the Angolan situation, perhaps, and let's say the assets they have, but I think it's also kind of a more general perspective. I think you still have, let's say, the traditional investor perceptions of African assets, and I think some points are already mentioned: transparency, capability in the country where there's a sufficient expertise workforce, infrastructure, as political influence. So you have all these kind of, let's say, traditional, sometimes I would say, prejudices against investing in Africa. But I think what you see is that quite a lot is changing. I think if people look a bit closer at what is happening in particular countries in Africa, you also see that many of these kind of potentially negatives have gone away, and that investors actually get more excited about different aspects that you can determine. I think the technological changes that are taking place, and the use of internet, fintech, for example, which I think is very interesting, how that is developing. And I think if you look also that from an investor's perspective, what you also see is things like ESG, sustainability, and so on, because also become kind of important items for investment. And I think many kind of Africa assets, many African projects actually could fit quite well in that new kind of focus on these kind of new trends. I think if you ask me, like, what are the capital flows going to be? I think it depends a bit, let's say, on the nature of the business. So you can imagine that these kind of international companies like Sonangol and Diama and so on will certainly create quite an interesting international investor base with big institutional investors. I think if you look at the program, for example, you also see that there are kind of smaller assets and perhaps more regional assets in the form of industry, agriculture. You can imagine that there it could be quite interesting to see how, let's say, regional investment is going to work out. In particular, also if you look at the African and the economic union, whatever that's going to take place. So I think it will depend on the assets what kind of flow will come, but I think it's certainly becoming more and more attractive for foreign investors to.
And I'm glad you mentioned ESG, because that is an emerging factor. I mean, everyone is talking about it as a consideration these days in investment. And I'd like to ask Sunita, not putting you on the spot, but what are the conditions, from how far we've come, as well as the new emerging factors to consider while investing? What are some of those conditions that ideally would help our privatization programs succeed today in this region?
Well, there's the usual list of things that come up in terms of, the conditions for successful privatization. I think one of the first ones is really strengthening country preparedness. There is often a lot of opposition to privatization. So how do you build the case for making these companies, move from being wholly state-owned to being private companies? These are crown jewels, of the economy, and there's just a lot of significant resistance and pushback from a lot of different quarters. So I think one of the key issues is how do you build and prepare for privatization in terms of the countryside? How do you, from the countryside, how do you put together sort of the key components that are needed to have good privatization? A clear legal framework, legal and regulatory framework, an institutional framework, institutional capacity, having a proper privatization agency in there that has the clout and the ability and the strength to push through these controversial reforms and to make these privatization transactions happen. So strengthening country preparedness and making sure that the country has the basic foundation to lead a privatization program and to implement the program. I think that's one of the critical pieces that needs to be addressed. A second key question is or issue is the nature of the market into which a company is being divested, whether it's competitive or non-competitive. Now, on the competitive side, we know that privatization is going to yield, in competitive sectors, yield solid results. And there's no real question about how this process is going to go. It's pretty straightforward process through auctions and tenders and so on and so forth, the competitive bidding. The more Obviously, the more challenging side is on the non-competitive sectors. And there, I think these enterprises are larger. The stakes are much higher. There's much more resistance within these companies. There's lots of inefficiencies. There are lots of policy and regulatory issues that need to be resolved. So that is really a different ballgame altogether. And I think the question is, how do you take some of these companies individually and transform them? You may have to have the legal regulatory framework. Well, you will have to have a legal regulatory framework in place. Talking about Ethiopia, I was working in Ethiopia for a long time before on this very issue in terms of public enterprise reform, starting from scratch. And there to develop the legal framework for privatization and also the state ownership framework in terms of the laws and regulations. That took us almost, I want to say, close to 1.5 to 2 years, because these processes are, in terms of the client country, there are lots of different opposing factors, and people are fighting tooth and nail about every single thing that goes into a law, because once you have that law, then you're stuck with it. So we spent a lot of time just having the basic foundational laws in place to facilitate a proper privatization process. Then we worked a lot with the Ethiopian Ministry of Finance and with and the team that is in charge of oversight of the program in terms of understanding the sector, in terms of disaggregating the companies, in terms of putting strategies for each sector there. So it's a long time consuming project. There's lots of opposition that comes up from different quarters. So we have to make sure that the political economy issues are being addressed. And I think in terms of sort of how to move forward, the country conditions do matter. So it's much easier when the country has a market-friendly policy environment, when there is that clear legal and regulatory framework in place, the institutional regulatory capacity, and also the macro and public sector reforms. Now, one of the key issues is whether, speed matters. There's some people who say just privatize quickly, get this out the door. But is there something else that needs to be done? I mean, speed is fine, but if you rush through a transaction, doesn't come out just to get it done, may not come out easy. So you also have to balance it with, making sure that what is being done is right. The speed versus that balance, I think it's, you make sure you don't want to be giving away special privileges and protections and so on and so forth. You have to make sure that process is done properly.
And that's, and that's a lot to unpack. And I'm going to be asking Kevin as well about the way forward. But briefly, Kevin, if I know countries are different, but if I'm to put a scale of 1 to 10 from what Sunita said, how prepared are the countries when you're launching or want to launch a privatization program?
I think it depends on, each country is different. Some are further along the journey than others. And I would say it's really the outlook of, is there an acceptance of the cascade approach? In other words, that if there's a role for the private sector to first participate, then it limits the government's use of its own funding for truly development aspects. And I think if that perspective is in place, then we find things a lot further along. If that perspective is not in place, then there's often an education process. I don't think we've not come across like, we will not do so. It's what are the benefits of doing this, right? Because some, governments have different views of what are, as was described, crown jewels. What are the real estate assets that need to remain in the hands of the state? Those conversations are ongoing across different countries.
Yes.
Okay. Peter, let me ask you about the risks. What are the risks involved? What should investors be aware of? What are those domestic nuances they should be aware of when they want to come in and participate in these ventures? I mean, to talk of Angola, for instance, they want to open up. We have seen risks associated with privatizing before. It could be an FX risk, it could be a social risk, it could be a political risk. And like Kevin has said, there's some crown jewels and people are quite emotive about them. What are the risks involved? What should people be aware of?
Well, I think you already mentioned some of the, let's say, the risks, and I think people who have invested or work with Angola are aware of the issues that have arisen from the shortage in foreign currency and the difficulties in getting money out of the country. I think that is something which people, let's say, have to realize that maybe that the issue is there. I think as a result of the increase in oil prices, perhaps it's improving. But I think some of the risk, I think that you mentioned, and I think both Kevin and Sunita already mentioned, I think things like having a developed kind of legal framework, having thought about the process and so on, I think that has been done. So I think in itself, there is quite a established legal framework for the privatization, but also, let's say, for private investment generally. I think what also has been helping to mitigate the risks, because I think one of the risks indeed is that you end up with, as an investor, with assets that you cannot really use or apply, or that are subject to all kinds of discussions and in fights with employees and so on. So I think one of the things that has been done, I think people have learned from the past. People are also learning, I think, who are currently working in the privatization department about things that things that do. So I think that's quite positive. So I think that, there are let's say the risk, but I think the Angolan government has been trying to mitigate them. I think what I find also to consider, let's say, a risk on the other side, and I think that's quite important, particularly for assets that need, let's say, also the input of know-how, is for the Angolan government to find the right type of investor, and also to have, let's say, adequate legal arrangements that actually oblige these investors actually to comply with their obligations. I think quite often we look at it from the investor side, but it's also important to look at it from the other side.
And one of those things the countries usually care about is local content. Sunita, you should know this, better than everyone. In terms of local content, and it takes, different shapes and forms. It could be restructuring labor, it could be local supply chain. Tell us a little bit about this and what governments should be doing to ensure that they address this appropriately with investors.
This is, I guess, I haven't really given that much thought to local content, to be perfectly honest. But I think in terms of certain issues when it comes to state enterprises, certainly on the supply chain side, yes, that, to the extent that they can build in local content, I think that's one of the critical issues. The other issue, I guess, on the local side is in terms of these SOEs themselves. If you think about privatization and restructuring, there's quite a bit of local staff in these companies. Many of these SOEs are overstaffed. There's a lot of overstaffing there. So how do you, make sure that the local population is protected through, severance packages, retraining programs, finding ways to move that needle. So, I think it's an issue that cuts across many different parts of.
I'm afraid we have 1 minute left, and in that, I'm just going to ask Kevin the final question of what is the outlook as far as privatization in this region is concerned?
I would say that, particularly in light of COVID pandemic, with so many government balance sheets under strain, the private sector will need to play a bigger role than it did in the past. I think Africa will need, I would say, $280, odd $1 billion in the next 5 years, just to accelerate the economy and fight the pandemic and climate change. I'd say also with things like blocks such as the African Continental Free Trade Area, this would require the full involvement of the private sector. And so the outlook for privatization, or rather greater private sector involvement is definitely bright. Considering that these programs can reduce the state's footprint in the economy, they can promote private investment that enhances job creation, and they can lead to increased tax collection, and also promote greater availability of products and services for all the citizens.
Right. All right. Kevin Giraini, the Regional Director, Southern Africa, Nigeria, IFC. Peter Van Welzen, Senior Consultant, Financial Markets Africa, CMS South Africa, and Sunita Kikeri, our World Bank veteran. Thank you so much for joining us in this session. And to our esteemed audience, thank you so much for watching. And please stay tuned as we have more great interviews that are coming up in the next hour here at Invest Global. Thank you.
Thank you very much.
Thank you.
Bloomberg Invest Global continues. Please stay with us. Now, all you have to do is to return to the main agenda to access the next session. It's as simple as that, so we hope you stay with us.
2 years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues Chinese stocks listed in the US suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
I'm Eric Schatzker, editor-at-large with Bloomberg Television, and I'm here in New York City with Mike Arrighetti, the CEO of Ares Management. Ares is the leading firm in direct lending, a giant, I would say, of the alternatives universe with more than $260 billion in assets across 4 main businesses. Mike, it is really good to see you here in person.
It's so good to see you in person, and it's great to be called a giant given my stature. It's not something I really grew up with, so I appreciate that.
Mike, do I have it right that Ares raised more money in the first half of this year than in all of 2020?
Pretty close. Yeah, pretty close. Almost spot on. We raised about $40 billion year prior, and we're about $35 billion through the first half of the year. You know, the demand for alternative product around the globe that we're seeing from institutional and retail investors, particularly on the backside of the pandemic, is really quite incredible.
It is incredible. I was going to say extraordinary, but you've effectively doubled the pace. What's driving all that demand?
I think 2 things. Pre-pandemic and over the last 10 years, there's been a meaningful shift in what I would call awareness of alternatives. So going into COVID, if you were looking at growth in alternatives, the industry at large was probably growing 10% plus a year. The larger firms like us are capturing disproportionate share of that growth. So we've been growing 20% plus per year. Big driver, low rates, persistently low rates. So if you're a fixed income investor, you're frustrated with the interest rate backdrop.
You've been crushed.
Absolutely, and there's nowhere to go. Alternatives, whether you're buying high-grade fixed income alternatives as an insurance company or, you know, racier down the balance sheet alternatives, that excess spread is more valuable than ever. Post the pandemic, the durability of alternatives really shone through. So if anybody was on the sidelines, underallocated to alts pre-pandemic and saw the performance, with this reopening, we're just seeing a real resurgence in demand.
Well, they need only look at the performance that many endowments just reported, right?
Exactly.
Not all of that is from businesses that you're in. Some of it is from growth equity and venture capital.
But a lot of it's private equity and private credit and alts generally. I think that's a big vote of confidence, if you will, for the alternative strategies.
Mike, tell me about what's happened since June. Has the pace of fundraising you saw through the first half continued?
Absolutely.
Really?
And we've put out guidance that we expect it to continue for the next 5 years. We had a recent investor day where we've been pretty resolute that we think that we'll get to $500 billion in AUM in the next 4.5 years. The nice thing about alts is, given the rhythm of fundraising, we can look forward and see that growth just based on where we are from a deployment standpoint.
What happens if there's a hiccup in the market?
Well, we had one, right? We just had one of the biggest hiccups that we've ever experienced, and the performance of the portfolios was exactly what we hoped it would be. Fundraising accelerated, financial performance at the underlying portfolio companies has been great, and the financial performance of the parent company has been equally as good.
I was thinking about a different kind of a hiccup. I was thinking about the kind of a hiccup that Bill Dudley, the former president of the New York Fed, has been talking about, which is an inflation-driven hiccup, where the Fed is forced to raise interest rates the way that it did between 2004 and 2006 at a very rapid pace. That would be a very different kind of a hiccup than the one we had during the pandemic.
Yeah, it would. One of the benefits of alternatives that doesn't jump off the page, but it is important, is as the business exists now, it used to just be private equity or venture. Now it runs the gamut from private equity all the way through to high-rated fixed income alternatives. So when you think about the funds that we and others like us manage, we have 250 funds, 20 different strategies. All of our credit assets, for the most part, are short duration floating rate that benefit from rising rates. We also have infrastructure assets and real estate assets that benefit from inflation. So a well-crafted alts portfolio should still outperform if we're in that kind of an inflationary environment.
You've told investors that you see yourselves doubling in size over the next 4.5 years. But that would be a slower pace of growth.
It would.
Than the one that you've had over the past 2 years. You've almost doubled in size over the past 2 years. Some of that, a little bit of that is from acquisition, but most of it's been organic.
Yeah.
Why don't you see that pace of growth continuing?
I think we're allowing for uncertainty, market changes, but we're pretty bullish on the prospects for the company. So we've said consistently in the past that we've expected that we would grow 20% plus per year, and we've done better. So our hope is that we could do better, but we're not out with that guidance right now.
One of the phenomena that is playing out in the industry, which you touched on, is this idea of the big getting bigger and capturing a disproportionate share of new money.
Yeah.
What's driving that?
It's a couple of things. First and foremost, in alts, when you think about how do you create value, it's size. And that, as an investor, when you're a liquid markets practitioner, is somewhat counterintuitive, because we're all taught that there's a point at which there's a capacity constraint or the information advantages break down and you can't drive out performance. In alts, the value gets created with origination. Who can originate unique assets at scale? Who has flexible capital that's more relevant to the market that they invest in? Who has flexible capital? Who can hire more people and pay them more and retain them and develop them, invest in growth? So what we're all learning is scale is a huge advantage in driving performance, and the investors see that. There's also an efficiency. So unlike any product that people consume, as we've gotten larger, our brand stands for something, right? It stands for consistent outperformance through cycles, excess yield. So both retail and institutional consumers of alternative product look at the larger brands and know what they stand for and what they're getting when they invest with us.
You bought Landmark Partners in March. You bought the U.S. real estate business from the Black Creek Group.
We did.
In May. Tell me about consolidation in the industry.
Those are two really good examples, because both of those were very large, well-tenured, well-performing platforms in their own right. So Landmark is a 30-year veteran in the secondary space. That business is going through transformational change right now as secondary liquidity is trying to keep pace with the growth in the primary markets. So I think the partners at that company looked and said, while we can go it alone, the advantages of being on the Ares platform in terms of the access to capital, the sourcing, all the things I just talked about, argues for an affiliation. What we now can do is take that institutional quality platform, globalize it, diversify their product set, bring on new talent, give them access to all of our global sourcing, and really transform that business.
Tell me about how you think about the spread of the business and the role consolidation needs to play. Are you responding only to what you hear from clients, or are you looking at your competitors? And I could name a few of them. There's Blackstone, there's Apollo, there's KKR, there's Carlyle, the list goes on, of course, and saying, oh, they can do those things and we can't, and we need to if we want to compete for the same assets they're getting.
It's a little bit of both, and it's changing and developing over time. So at Ares, we have a corporate strategy group that all they do is look globally at addressable markets and how we could play. What's interesting, you're hitting on it, as we've all gone public and as we've grown in the public markets, there's not that many secrets anymore, and the translation mechanism is much quicker. So the velocity of new ideas, the velocity of new structures, the velocity of capital, it's all accelerating. And in some respects, while it's changed the competitive dynamic, it's also feeding this consolidation trend, right? So you could be a first mover, but the advantage of being that first mover now is so critical because everyone can see what you're doing and the investors will move much more quickly to get into those markets with you if you move into them.
There are few firms that can compete with Ares when it comes to direct lending at scale. But relative to some of the other firms that I mentioned, you are, dare I say, subscale in private equity, subscale in real estate. Is part of the ambition to be a scale player on the level of those firms in those businesses?
Yeah, I would say real estate for sure, and our real estate business is growing quite nicely, both organically and inorganically, globally, back to the Black Creek acquisition. Infra, same. Credit. Private equity, that's a great business. In my mind, it's not a growth business. And while you can invest at scale, the addressable market opportunity just isn't the same. So not that we don't have ambitions to continue to grow in P and diversify, but I would maybe put that off to the side as a slower growth.
Why is that? Why is what you're effectively saying that the glory days of private equity are somewhere in the past?
No, I'm not saying that. I just don't think that if you think about the capital structure and available assets, back to my comments just about origination and sourcing and delivering excess return, the addressable market in credit, real estate, infra just dwarfs the traditional private equity business. So, we have a meaningful PE business. It's roughly $30 billion in assets, continuing to grow. You're just not able to drive that kind of stable, consistent growth in PE the way that you do in some of the other products.
Do you see yourselves being a consolidator in the effort to grow in those businesses, to get bigger in credit, to get bigger in real estate, to get bigger in infrastructure?
I do. And if you look, we've been fairly acquisitive, but where we're acquiring, it's where we see a market that is large and growing and maybe transforming. So Black Creek, as an example, large industrial real estate developer and manager, huge secular tailwinds in industrial logistics. If we can buy that and then add value to it, we can meaningfully grow it versus them standalone. So when we're making acquisitions, we're looking for growth markets or capabilities that we can't build organically because we have a sense of urgency. But as we're getting larger and the access to capital is maybe easier, we're now marrying people and capital much more fluidly and easily than we did in the past just to launch new businesses organically as well.
At what point, Mike, do you see these large alternative platforms, Ares and some of the other firms I mentioned, start to acquire one another? We saw maybe the beginnings of that trend with a combination of Owl Rock and Dial into Blue Owl. Those weren't two big platforms buying one another. It was sort of two smaller platforms forming a bigger one.
Absolutely.
But it seems to me the beginning of maybe something in the future.
I think you will see more firms coming public. I think many of those firms will be single asset or asset specialists and
like
things
Peters
like
Hill?
Peters Hill or in real estate or in infra. As that universe of public entities comes, the valuation discovery becomes easier, and I do think you'll start to see alt consolidation as well.
How many years away is that?
In terms of the IPOs or the consolidation?
No, the consolidation part. The IPOs are beginning to happen now.
It's happening now at a lower scale. I think at scale, I would not be surprised to see something within the next 5 years.
Is that something you can see yourself doing?
I think we're pretty well diversified, right? So if you look at the large publics, most of us already have the management bench strength, the diversity of product, the distribution. So I'm not sure that we will participate, but I think you will see, back to the Blue Owl, some of the mid-sized platforms coming together to try to build up that scale and diversity.
What percentage of your new money is coming from retail channels as opposed to the traditional institutional channel?
It's a great question. Retail is accelerating at a rapid pace. So all of the frustrations that institutional investors have had over the last, 2+ decades of persistently low rates and volatility in the equity markets, now, particularly with an aging demographic, retirees around the world are saying, how do I access alternative investment product? So last year, if you think about our non-traded product, our listed vehicles like our BDC and our mortgage REIT, it's probably 20% is coming from retail, and that number is accelerating pretty rapidly.
Do you think we've crossed the chasm in the sense that the pandemic, by crushing yields as quickly as it did, on treasuries and, of course, on corporate bonds help fulfill the industry's dream of retailization? It's here to stay?
It's absolutely here to stay. If you talk to any wealth firm, any of the bulge bracket or the wirehouses, and you say, where are you taking your allocations? They're going to double the alt allocations in retail portfolios, the same way the large institutional allocators are doubling alt exposure as well.
The flip side of fundraising, of course, is origination. If I'm not mistaken, Ares was the first direct lender to underwrite a $1 billion loan. How many loans of $1 billion or more are you underwriting in the space of a year now?
It's accelerating. Obviously, the market today is pretty unique. We've got high M&A volumes, disproportionate share of that M&A volume happening here in the North American market, disproportionate share of that North American M&A happening in the buyout community. So we're setting records from M&A, but about 40% of M&A volume this year is large buyouts. That's driving a trend for the private credit markets to provide customized solutions into those deals in a way that we haven't really seen before.
That's not necessarily a sustainable trend.
I think it will be sustainable in the sense that the markets understand the value of those private solutions in terms of speed of execution, certainty of execution, confidentiality, ability to scale and grow. It's a little bit episodic because, again, you need an M&A backdrop and a capital markets backdrop that allows for us to take that share. So I think the trend is here, but the volumes will be a little bit more episodic.
The sponsors, though, are coming to you for these loans. They're coming to Blue Owl for these loans. They're going to Apollo for these loans. Why are they turning to the alternatives platforms instead of where they used to get the money and still could get the money from the banks?
It's all the things I just mentioned. So there's just an ease of use.
It's not easy to get a bank loan? Surely if you're a big financial private equity firm, it's not hard to ring up JP Morgan and get $1 billion
It's harder
loan.
than you would think. There's a rating agency process you need to go through. There's a syndication process you need to go through. So you're always kind of navigating to the lowest common denominator in the market. If you're looking just for price execution, you'll go to that market because by definition, when you syndicate, you're going to get better price execution. But if you want creativity in your structuring or speed, or if you're doing a take private and you want to keep your lender group small because of confidentiality, you're going to go into the private market. So there are clear circumstances where the private markets, even though they're more expensive, offer a much better value proposition to the sponsors, which is why they're using it.
At that level, how much more expensive is it?
If you look at the total capital stack, it could be 100 to 150 basis points. The spread is probably 50 to 150. So it's a meaningful premium. But if you think about the impact of that premium on the overall return of that transaction relative to the flexibility you provide, it's not that impactful. And I think that's the thing that people don't fully appreciate.
Look beyond the price, in other words. What's the biggest loan you could see yourselves underwriting?
Well, we're already underwriting, $2-3 billion loans, and the market is very quickly moving to club loans in that $2 to $5 billion range, and I could see us continuing to be active there. That trend is emerging in Europe very rapidly as well. So Europe has historically been 5 or 10 years behind the U.S. market, but this large loan, large LBO trend is accelerating there as well. I think once you get above that $5 billion, a lot of the benefits of public market execution will kick in and make the private market execution less attractive.
I mentioned a couple of the companies that underwrite large direct loans. Who do you think of as your most direct, largest competitors?
In direct lending? The direct lending
maybe
business,
in that league, let's say.
Yeah, I think there are a handful of folks that can underwrite those large transactions. We at the top of the list. Blackstone, very active in that market. Goldman Sachs active in that market. So there's probably half a dozen folks that have the capital base and the capability to do it. No one's been doing it longer than we have. The key for us really has been to build a middle market origination engine that goes all the way down to a $5 million company up to a $5 billion company, because what we're finding over time, 50% of our loans are coming from companies that we already have a lending relationship with. Right, so they come on, they're much smaller, and we grow with them, and then they never go anywhere else.
Mike, what is Ares' position on ESG? Will you lend to coal companies? Will you lend to frackers? Will you lend to, so to speak, dirty companies?
So ESG is front and center as a core strategic priority. Our ESG function reports directly to me as the CEO. It's an interesting way you phrase the question, because ESG historically and now still is, what won't you do, right? So the answer is no, we will not invest in coal. No, we will not invest in dirty companies. But the bigger question for ESG going forward is, what will you do? Meaning, what will you do to transform the companies
Yes, that's fair.
that you can impact? And that's the transformational shift that's happening. It's very easy to negative screen.
The reason I asked the question is not because I'm trying to think about it in old school terms. It's with the thought that if companies like yours, and banks for that matter, and other credit providers decide that they're not going to finance coal, they're not going to finance fracking, they're not going to finance, upstream oil production and exploration, the cost of capital for those companies goes through the roof, and you have to wonder
who will.
Yes.
Yeah,
who will?
It is a very interesting question, because, as you know, we have historically invested in midstream assets. We're even de-emphasizing some of those investments, as are our large
pipelines
LPs.
And the like.
We're very heavily investing in the transition of the economy. So climate infrastructure. Today we announced a very sizable transaction in the wind development space. But in an optimistic case, we have a 20 to 30 year runway to see that transition happen. And you're right, there's a big capital gap in the market right now to sustain the in-place assets while we transition, and the cost of capital is not getting any cheaper.
Mike Arrighetti, the CEO of Ares Management, thank you very much for spending time with us.
Thanks, Eric. Really
at
appreciate
Bloomberg
it.
Invest Global. Thanks, everybody.
And hello, I'm Stephanie Flanders, head of Bloomberg Economics and senior executive editor for economics at Bloomberg. And I'm delighted now at Bloomberg Invest Global to welcome Greg Jensen, the co-chief investment officer at Bridgewater Associates. We have so much to talk about, Greg. Thanks for joining us. I want to get straight to it. It feels like it's been a matter of weeks that we've gone from worrying about the pandemic and about lack of demand to worrying about supply shortages and possible stagflation. Is there a structural shift that has happened, or should we all just take a breath?
Well, I think it's been longer coming than that, Stephanie. First off, thanks for doing this. Basically, if you take the big thing that changed in this crisis relative to prior crises is the nature of the response by policymakers. That if you go back to the tech crash in 2000 or 2008, the first move is interest rates go lower. The second move in 2008, of course, is printing money to buy assets. But the move that occurred in this crisis was printing money to replace incomes. And that's essentially what we call monetary policy 3, but the merger of fiscal policy and monetary policy. And this is an incredibly powerful weapon, much more powerful than interest rate declines, which create more credit through incentivizing credit in the private sector. Monetary policy 2 works through driving up asset prices, but that money seeps into the economy quite slowly. Printing money to make up for income losses is a whole different ballgame in the sense of it enters the economy, and it enters the economy without creating offsetting supply. Normally, when somebody gets income from working, they're creating supply and simultaneously demand. Getting demand created through money printing without offsetting supply is kind of the big thing that's been happening for a while. Now, over the last 6 months, 9 months, some of that is masked by the ability to run down inventories. But what you're seeing in the world today is we're out. We're out of most things. The inventories have been run down. And so you're starting to see the ramifications of demand without supply. Super powerful weapon that was super effective in maintaining pricing pressures, in essentially bringing the economy back at warp speed from what would have been a devastating hit. But it is a much more inflationary weapon than the tools that have been used before. And now we're living through that, right? And now the Fed is gradually accepting that. They want to stay behind. They will stay behind. They're purposely learned a lesson in 2018 that Powell is committed to not repeating, which is tightening preemptively to inflation rather than lagging behind it. That has implications. The lagging behind it means the economy is going to continue to run these hot spots where very low real interest rates housing everywhere in the world, and so on, and capital expenditures by corporations will pick up to very hot levels, and the Fed will be extremely slow. But what's happening in the economy is now what we'd kind of describe happening at warp speed. So you had policymaker response at warp speed, markets rebound in a rate much faster than any other crisis, and you're seeing the follow through in the economy. The economy is obviously slower than the markets, but happening at a rate we're just not used to. And so you're seeing us rush into the late cycle where there's not enough supply and there's a tremendous amount of still pent up demand. And that's the circumstance. And in our view, that's going to drag the Fed along. Those economic conditions, inflation staying higher than they expect, will pull them to tightening faster than they expect. And that's a big deal to markets because so much of the current asset price levels are a function of the liquidity and interest rate levels that we see today. And particularly assets that have benefited from the liquidity, assets that themselves don't produce cash flow to support them, but rather require new liquidity in order to support them. So any asset that's based on no income and is essentially not going to move with nominal GDP and inflation in terms of their income, those assets will probably be hit relative to the assets where you get some of the benefit from the surging nominal GDP that's occurring.
I mean, you talk about, it's an interesting point that we have a lot of things operating at warp speed, but certainly the real economy not operating like that. And we see it all the time. Our reporters are seeing that the container ships not operating at warp speed. Your point about the Fed is a good one. If the Fed is sort of realizing now it might have to go faster, or at least remaining committed to its current path, despite the nervousness in the markets, is it that, I mean, investors, have they just not got to grips with the fact that the Fed can't create semiconductor chips overnight, can't magic up more container ships overnight?
Yeah, exactly. I mean, I think in part that's, when we look at this, we've lived through a world where the problems the Fed faced were problems the Fed could resolve and have gotten really used to that in markets in the sense that 2008, the problem was there was not enough credit. The Fed can turn on the spigots of credit very easily and offset that, right? It was bold on their part relative to what they had done historically, but they're capable of offsetting credit with printing money. They were also capable of offsetting income by printing money in this thing. But what they're not capable of is creating the supply that would have been created that would normally have generated that income. And so you're seeing that, right? And what you're seeing is we're hitting policymaker constraints. We have a measure of policymaker constraints, and certainly you want to be more bullish on markets when policymakers are free to react to any downturn in the economy. When they're constrained, and basically there's three constraints that we see that can affect policymakers' ability to step in a problem. One is when that problem is inflationary, when it's essentially a supply side problem that demands above supply, they can't just easily step in and solve that problem. Currency problems as well, and bubbles in asset prices. And today, the Fed faces certainly the problem of inflation being well above their target and the inability to be as easy as they'd like to be and being pulled along by that. And certainly the increasing odds that we're facing bubbles in certain areas. And so the third problem that would really force them to move is more of a currency problem. We haven't seen that yet. But those constraints put the Fed in a much different situation in terms of the nature of the problems we face than they were in 2008 or in the beginning of the COVID crisis.
I noticed there was an interesting column that Mohammed Al-Arian wrote the other day for Bloomberg Opinion, which was making some of this point and just arguing that maybe we've got so used to focusing on lack of demand as being the key problem in the economy, we're not perhaps responding quickly enough to the fact that the world has changed and now it's a matter of supply. But look, I'm pulling out, as an investor, I'm pulling out from what you're saying two things that are somewhat disturbing. The Fed's going to carry on regardless. In response to these conditions, and potentially inflation is going to carry on regardless, maybe higher than what is currently being priced in by markets. I mean, is that something that is going to cause a problem for investors down the road, the combination of those two things, tapering and continued high inflation potentially?
Well, to be clear, I think it's really the second that will drive the first, in the sense that the Fed won't taper if they don't need to, meaning that the only reason they're going to taper is because the inflation pressures don't go away. So if you do get some sort of downturn, or that we're wrong and somehow the supply comes online to match the current levels of demand, then the Fed will probably slow down. So there is a deflationary environment where the Fed slows down. The problem is more likely in our view.
But you're not seeing that.
Yeah, you're more likely. Exactly. More likely you have the inflation dragging the Fed along. And yeah, that's risky for investors. And so what can be done here? The big thing is that the only reason the Fed's going to tighten is if they have to. They're only going to have to if nominal GDP continues to increase at a rate that's driving inflation higher. And so you can hedge your portfolio much more than most portfolios are by trying to lock in cash flows in the real economy and go short things like treasuries, but basically arb the difference between the likely nominal GDP outcomes and the interest rate the Fed's currently giving you. We don't think they'll be able to give it to you for long. So those assets are in danger when you go through the tapering and interest rates rise. But today you could still get a good deal in hedging cash flows that are likely going to be higher than the interest rate. And so that's, one of the things that we don't think enough portfolios have hedges to the main risk. The risk in our view to asset prices is not deflation. It's not the old risk because we know what the Fed and policymakers will do in the end. If there's deflation, they'll print money and spend money, and that'll affect the prices of things. The problem is stagflation. That's the real risk. And so many portfolios are massively exposed. And there are ways to hedge that risk, to try to arbitrage that difference between the likely nominal outcomes and those available in financial assets today.
And you're obviously talking to a lot of institutional clients about that. I guess for the less sophisticated investor, they're looking at potentially a period where you have a positive stock bond correlation. It feels like there's nowhere to hide. What's your advice more broadly to people trying to think about what a balanced portfolio looks like in this environment?
Yeah, well, like you said, if that for institutional investors, the ability to try to at least hedge some of those risks and being short some assets while being long some assets is kind of step one. The other, but the geographic diversification is still available. The U.S. situation is different than the European situation, is different than the situation in emerging markets in China. And so much, 60% of global portfolios sit in U.S. assets, despite the U.S. economy being, only 25% of the world. So essentially, people are not even in a long-only kind of situation taking advantage of diversification. And these problems, the manifestation of inflation, the labor shortage in the U.S., those problems are very different than the problems China faces and very different than the problems Europe faces. So being at least somewhat better diversified geographically and as much as possible across assets, having some commodity exposure, having some equity exposure, and being more balanced are the steps that everybody can take to deal with the wide range of possible outcomes today.
Well, of course, in my former, I had a former life at JP Morgan where we spent a lot of time trying to get people to diversify, and it's a good strategy. But in the last few years, if you persuaded clients to go outside America, they tended to do less well than if they just stayed in America. But you think this is really a new environment now?
Well, I wouldn't say it's new in the sense that's always possible, right? You should never diversify away from the best performing asset. Of course, you just don't know, right? Maybe somebody did know then, but the benefits of diversification, this is one of the reasons it works so well, is people tend to make that huge mistake of going into the asset that's done the best looking backward. If you look at the situation today, the US is priced for perfection, right? There's a lot of challenges. Any way you look at the challenges in the US, you've got this essentially economy with strong inflation pressures, requiring a lot of fiscal policy, very low interest rates, paper wealth at extremely high levels relative to incomes. Lots of challenges. On top of that, of course, everybody's living the political conflict and the risks associated with that. And yet everybody's pouring in to U.S. assets based largely on the thing you're saying is for the last decade, that was by far the best thing. But if you look decade by decade, it's almost always true, like just super simple strategy of go short the equity markets that were that did the best in the last decade and long the ones that did the worst, that works by itself. I mean, I wouldn't recommend that as it's overly simplified. But the reality is the expectations for US and US technology are so extreme relative to the rest of the world that not only does the US have to massively outperform economically, it's got to outperform faster than it did over the last 10 years in order to outperform on a financial basis. So that's a huge deal. And it is different. The pricing certainly radically different than it was 10 years ago. And the range of outcomes, who knows, maybe the US just dominates everything and you go from 60% of assets in US assets to 80%. But more likely, you go from 60% to something more in line with the US's relevance in the world.
Okay, we got that message. This time is different, says Greg Jensen. Look, if we go to one of those outside opportunities, China is a country, a market that Bridgewater's been very enthusiastic about in the past for many good reasons. We've had a pretty negative news flow out of China in the last few months, and a lot of questions even about the investability of China. How are you seeing that? And what would it look like, do you think, for China to become uninvestable?
Yeah, well, a few things. I mean, everybody looks at the equity market, right? This is across all.
Which has performed horribly.
All investors, right? But that's not really our perspective. We look at a balanced mix of assets and what can you do in China, right? So a balanced mix of assets in China, if you include China equities, China bonds, commodities, et cetera, is up steadily this year. So up this year. So yes, stocks are down because policymakers have made decisions balancing several goals that they have. They have goals for common prosperity. They have goals to make sure that information security and that no company becomes more important than the party. They have goals also of becoming a world superpower for which they recognize they need to be an investable financial center. And they're going to be. They've been moving in that direction over the last 25 years, step by step. Every once in a while, whether it's 2015 or whatever, they take a step backwards to achieve some other goal related to stability. And you're seeing one of those. But I would not extrapolate that to mean they're moving away from building financial markets that compete globally, that attract capital, because they recognize that every superpower has always had them. Their plan is to be a superpower, and they're moving consistently in that direction. So we do think it's investable. The health of those markets can somewhat be shown by the fact that the balance between assets has worked as it always does as it has normally in other countries, and in fact is more reliable today in China than in the US and Europe because interest rates are at a more normal level. So when stocks do go down, bonds rally in a more predictable way than, let's say, in the United States today. So those are the issues, right? But unquestionably, there's regulatory risk in China. They are building, they don't have the rule by law setup that we have in the West. They're coming up with the laws today and sort of doing what we'll call rule of law, but they don't have a structure for how to deal with these companies, the profitability of these companies. That's all happening on the fly. And that's messy and certainly create nerve-wracking situations for investors. But if you look at that, a lot of that is priced in. I mean, the same asset in China relative to the US is probably at a 40-45% discount in terms of if you're looking at reasonably similarly expected cash flows. So maybe that should be worse. Maybe that should be better. Our basic point would be you're still better off having a diversified mix of Chinese assets with US assets. And that's been the case, again, recently, even in this year, if it's not an all equity-based investment.
Well, the bond market has certainly done well. But I guess the wild card, which could overturn the analysis that you've just given, is this potential for US-China relations to just deteriorate drastically. You've got the Chinese authorities actually discouraging Chinese companies from listing in the US. You have, I noticed, the Commerce Secretary last week, Gina Raimondo, saying that the US needed to rally its allies to slow down China's rate of innovation. This feels like quite a potentially difficult situation for investors, surely.
Yeah, that's right. I mean, it's difficult on both sides. That's not bullish for U.S. assets either. The fact that we're moving from a collaborative world to a competitive world between China and the U.S., not that it was all collaborative before, nor is it all competitive today, but it's certainly transitioning in that direction. And economically and financially, who will win? Like there is That's a big question. I don't think it's clear in terms of that, and having some balance in terms of a portfolio is a big deal. But you're right; it's going to be competitive. Hopefully, it won't come to war per se, but that it is a competitive situation, and that is going to change things a lot. That is part of the supply chain story. That's part of the U.S. needs China. China needs the U.S. And you're seeing it when China's struggling to meet production demand, and they don't have the electricity to do it because production demand surged during COVID from China. Now it's at levels that they can't simultaneously meet those production and their goals on climate. So now you have a constraint that's hitting the whole world, right? And that those risks flow back and forth between China and the U.S. It's not just China that will suffer in terms of financial consequences from those challenges.
I want to get to a final question, but just to go back on that, I'm intrigued. I mean, as an investor who's so active in China, do you find that unhelpful when a U.S. Commerce Secretary says something like that? I mean, if you can imagine if a Chinese official said, we want to slow down U.S. innovation, that would cause uproar in the U.S.
Yeah, well, I mean, it's just our reality, right? Like, this is the world we're in. We're in this competitive world, so I don't see it one way or the other. I do think that's more a reflection of something everybody already knew than something brand new. And so I think that reflection, that is it. We're going to split the technological world. We're going to split up in these ways, and managing a portfolio that is acceptable, given the range of ways that might play out, is a big deal. What if it plays out in a hot war? What if it plays out in terms of dividing these supply chains up? Who's going to benefit? Who's going to lose? Now, there's a lot that's unknowable, but the best tool in our view to deal with that wide range is not to take a lopsided bet on just it being great for the US and bad for China, or vice versa.
Okay, we are out of time, but I want your 10-second answer to Amy Ko, who from HSBC in Hong Kong, who wants to know what growth sectors you see in 2022. You've got 10 seconds.
Well, I think the big thing is the growth sectors are going to be the areas that benefit from this huge rise in nominal GDP, that can essentially have the pricing that aligns with the inflation pressure and don't have the costs. I can't get into all of that, but that's where you'd be examining companies, both historically, how their pricing relative to their costs work in this type of supply constrained environment.
Greg Jensen, thank you very much for joining us.
Thank you.
Romain Bostic here from Bloomberg Television. A great start to day 2 of the Bloomberg Invest Global Summit. Of course, we just heard from Michael Arrighetti there, of course, and Greg Jensen over at Bridgewater. We have an impressive lineup ourselves right now for this panel. David Hunt, of course, the CEO over at PGIM. Gene Hynes, of course, the CEO over at Wellington Management, and Julian Salisbury, global co-head over at Goldman Sachs Asset Management. This is a panel, of course, about the future of asset management. So let's get right to that future, specifically the long term, specifically earning returns long term, protecting against downside risk long term, and doing so in an economy that may be lower growth with higher rates. Let's start there. And I want to start off with you, Julian, on that question.
Look, it's obviously an environment where we're seeing heightened valuations by any real metric, both in the public equity markets, rates at near historic lows, credit markets compressed. So, look, it's a tricky environment to navigate. I think what you need is the more active approach is what we're finding is assets where we're really able to implement and generate alpha through touching the assets, whether it be private equity, more hands-on real estate type investments, things where you're less reliant and less sensitive to small rates in equity market moves and credit market moves. But I also think just diversification is key in an environment like this. I think, it's always hard. I think about it at the end of every year, we start about a process of how are we going to generate returns for the coming 12 months. And, I think each and every year for the last 20 years, I can remember business planning. It feels hard. It always feels hard. And the reality is if you have a broad investing platform, super high quality investment teams, there are always opportunities to generate returns, however challenging the market. You have to pivot, you have to change, you have to be agile, but there are always, I can't actually remember a year where people sat down there at the start of the year and thought it's going to be easy for the coming 12 months.
Yeah, well, if they thought it was easy for your jobs, of course, you three, of course, wouldn't be in the jobs that you have here. David, you, of course, are no stranger here to market cycles and sort of the ebbs and flows here that make your job so difficult here. When you talk about asset allocation in a world where, at least to the outside observer, everything looks expensive, how do you sort of position for that?
No, well, you're absolutely right, Romain. It is very unusual. I mean, the dominant theme and context for investing right now is negative real yields. I mean, it has never been more punitive to hold cash. And what that's doing is driving all of our clients to seek out yield wherever they can find it. And for the most part, that's been in, as Julian rightly said, it's been in private markets. We've seen a dramatic growth in allocations to privates. And we do think that the ability to manage for the long term through a lot of those gives them an advantage. You know, when you think back over 20 years, most investors were invested in either stocks or bonds, public securities. And you look now at what a sophisticated institution has an ability to be in, from all kinds of different versions of private equity to versions of real estate debt, real estate equity, infrastructure. The range of private credit has never been broader. So we're able now to offer our clients a diversity of private assets that simply weren't on the cards the last time we were in this situation. So that's really where we're spending a lot of our time with our clients.
I'd like to get your thoughts on this as well, Gene. And I think David hit on a great point here about you go back to what asset management looked like years ago, if not decades ago. It pretty much was just stocks and bonds, stocks and fixed income. And the universe now almost seems infinite.
So I would add, one of the things I would add to the commentary that Julian and David just talked about is the fact that this is going to be a market. This seems like a market where differentiated skill, like real research-based asset management, is going to maybe have an advantage versus maybe the last 10 or 15 years. And whether that's in liquid alts, long short, whether that's in the private markets, whether that's in the long only markets, which I still believe have an incredibly important place in the asset allocation of our clients. And if you can deliver alpha above a benchmark, that has the ability to compound, and that's still the vast majority of where our clients are allocating their capital. So I would add that active management, I think, is going to be more important in the next decade in the past. So we're investing in just attracting lots of capabilities across the whole spectrum of capabilities in asset management. I think the other thing I would say is if you look at the big macro picture where yields are and valuations are, I think there's a lot of diversity happening below that, a lot of diversity happening, between sectors and between stocks. So there's still a lot of opportunity that again leads to how do you want to be positioned from a research-based perspective. Sustainability is going to be incredibly important, and I think we can talk more about that. That's a micro issue. That's going to be stock by stock. How ESG factors are impacting each stock. And then maybe the final comment I will make is that we are still in a tremendous, there's still a tremendous amount of innovation happening around the world. And so how do you balance that with where valuations are now? The numbers of private companies and we talked about the private markets, and the private markets are attractive because there are just a tremendous amount of private companies being created across all categories of the world. I'm a healthcare specialist. The number of biotech companies being created is just really higher than it's been in my 30-year career following the sector.
I am curious, though, but with regards to the growth of some of these private companies, these sort of new sort of era companies, and whether they actually do come to the public markets. There are some people that look at these companies, they say it's a great opportunity. If you can afford to pair up with a Wellington or a PGIM or a Goldman Sachs Asset Management, that's great. There's a whole investable universe of people out there that don't have access to that. Is there a bridge between those two?
I think absolutely. I mean, I think what we're going to see over the next 10 10 years or so is democratization of alternatives, easier access to alternatives. Alternatives, you're able to generate returns because of the complexity of the investment process, because it's a very hands-on approach to source the assets, to impact the assets, to drive value creation into the assets. That's why you generate the returns through alternatives. Doesn't mean you should make the process of investing in alternatives as challenging. We need to make that as seamless as possible over time. And I think that's going to require a couple of things which all speak to the need for scale. One is huge investment in technology to be able to deliver alternatives in a seamless a way in the future as it is to buy a stock today. I mean, at this point in time, for the average person to get access to private real estate, private credit, it's a multi-week, multi-month process of getting onboarded, subscribing. The reporting's delayed. It needs to be driven to the point where at the click of a button, you can get access to these products same day and real-time reporting on what's going on at the portfolio level. And that's, I think that will result, we're seeing evolution in the wrappers that are available to make alternative products available to a broader range of people, smaller chunk sizes, tokenization, subject to regulatory overlay will drive that down further over time so more people can access it. But I think this will become, as obvious an asset class to people, as an accessible asset class to people over the next 5 to 10 years. And I think that trend seems to be accelerating.
Yeah, David, can you talk about that accessibility, or at least the move towards more accessibility?
Well, I fully agree with Julian. I think one of the things that we all need to focus on as an industry, and we'll need some help from the regulators in this as well, is how do we make those excess returns in the private markets available to Main Street? Because right now, most of that we're all offering to our institutional clients and some high net worth, but actually through broad retail channels, it's still quite challenging. And through technology, but also we'll need some regulatory help to be able to make more of these accessible. But I think that that's actually an exciting challenge, and I think it will open up a whole range of diversification possibilities for retail investors that they don't have today. Because the retail investor is still largely in that they own either stocks or bonds. And we need to make sure that they have the access to the same suite of asset classes for diversification and return that an institution has today.
Some would say, though, that one reason why we don't necessarily have that just yet is because of the risk, or at least the relative risk with some of those investments, as well as the research or lack of research that's available to a much broader universe of people out there. Do we get to a stage where we start to see a little bit more balance in that area, Jean?
Well, I think we're probably far away from seeing that on the venture side. So if you think about what's happening in private markets, it's the spectrum of what assets or companies are in private. Some are very, very early. There are a lot there. Some of the venture firms are starting companies. Some are very early. I think that's far away from the ability probably for retail investors to own that. As you get closer to the public markets, and you've seen this trend where companies are staying public, staying private much longer. Some of those would be public companies. Those companies, the interesting thing, to be able to follow public companies now well, to follow an industry well, you actually need to know what's happening on the private side. So you probably will need to see, you'll probably see more access to public investors or sell side researching the private companies because they impact the industry dynamics of a sector. So I think that will become more accessible as well.
I think that's a really important point, Gina. And I think that, Ramin, to your question about the structure of the asset management industry, this is where we're seeing a fundamental change. So again, if you were to go back 10 years, there were alternative players and they did private assets, and there were long-only players and they basically played in the public markets. And what you're seeing, and you can see this in the business models of my colleagues on the panel here, now we all have to be in both. And successful asset managers will do both public and private markets, and very successful ones will integrate the skills between those to come up with better investment ideas. And that's a big change in an industry that has grown up in two very separate spheres.
That's a great point, too, particularly with the model, PGIM's model and the partnership model, smaller partnership model that you have. I am curious, and I'll pose this to Julian, because you actually, I think, raised this point here about consolidation in the industry and whether there is even room anymore for that type of sort of monoline asset manager of old.
I think it's like many industries. I don't think you want to be stuck in the middle. I think you have to decide, are you going to be a scale player offering all products or the majority of products globally to your clients in whatever wrapper they require, so that you can serve a broader range of customers globally and deal with all of their solutions. If you look at our platform today, we have everything from money markets at one end through to secondary private equity at the other end in terms of the liquidity spectrum, and the ability to bundle that, wrap it, deliver it to people in a customized way, I think will be increasingly important. And the only way you can do that is to do it at scale with a huge technology resource behind you. I think there's going to be room for many years to come for smaller boutique players who are hyper specialized and can go deep, and they just do one thing really, really well. I think that will persist for some time, but I think to be somewhere in the middle is going to be increasingly challenging. Where we still have 100 asset managers with more than $100 billion. We have 20 with over $1 trillion. I think you'll see that continue to consolidate further, so that people can spread the cost of investment that's required to do this well over a broad base. And just one other thing on consolidation that I think is important. There's a danger. I think some people might perceive being big as being bad or detrimental to returns. I think you can be big as a platform without being big in or overwhelming individual asset classes or investment themes. So if you have a broad-based platform, you can invest in the platform, and then sitting on that platform, you can have different strategies, different managers. Some can deploy large amounts of capital, some can deploy smaller amounts of capital, depending on the underlying opportunity set. But it's the breadth of the overall platform that's critical from a technology, from a distribution perspective.
So I would say, Romain, that our multi-manager is the solution to this conundrum that you described. So if getting larger in an individual strategy or in an asset class does mean fewer and harder to find returns, and I do believe it does, but you need to continue to invest in the overall platform as a $1 trillion manager. Our solution is for our individual asset classes to keep those to feeling like they're a partnership and very focused and very tailored around their individual asset class. But then when it comes to brand or technology or some forms of distribution, I invest as a $1 trillion manager right around the world. And so we hope we get the best of both, of being small and focused with the investment being large. Because I think if you go with just large and integrated, you begin to lose your edge as an investor.
Yeah. Jean, you're a $1 trillion manager.
Yeah, so I would say we are large and integrated. So we've grown organically for our, we've been a private partnership for 42 years and grown organically to about $1.4 trillion in assets. But that, if you go beneath the surface of Wellington, that's 60 teams. So 60 teams that are globally integrated with an open collaborative platform where we share research. It's sort of a marketplace of ideas. So not separate companies, one global integrated platform. But I completely agree with David and Julian that scale is important. Particularly I think in the next decade versus maybe the last decade or the decade before, and that's technology, as we've talked about. If you think about how sustainability will impact the markets, that's going to be a data game. Data will be incredibly important to getting sustainability investing right over the next decade. So you do need to have the resources for both of those, I think, to be competitive in the next decade. And many of these new asset classes, privates, liquid alts, they require more. They're more operationally complex. So that's another area where you need scale investment. But I think the last thing I will say, but alpha is rare. So alpha is not a scale business. And I think David mentioned that. So you need to keep teams and individual teams, and we call them boutiques here at Wellington. You need to keep them small and nimble, and to be able to invest in small groups to really create the alpha.
I want to get to a couple of viewer questions here. One we have from Marianne from Zurich. She specifically wants to know about some of the regulatory issues out there, particularly regarding disclosure requirements and some of the disparities that we see between public and private companies, and how that, if at all, can be addressed. Who wants to take that?
Look, it's an interesting question as you force private companies to increase disclosure and you start creating mechanisms for liquidity. There is a secondary market for growth equity stakes. There is a burgeoning kind of increasingly, I wouldn't call it liquid, but there is a market for for private equity stakes. There are markets for many of these private assets, and at some point the lines become blurred between what's public and what's private. I think the key thing for us when we're investing in private markets is because you're able to go forensic, get under the hood, really take the engine apart. It gives you a higher degree of confidence to be able to look at longer term projections that you're just not able to present to the public markets. So I think that's a key differentiator. But I think just back on this regulatory point, one of the challenges I see here is we would like more people to have access to the higher yields available and the higher returns available in private markets. The democratization of alternatives, I think, would be a good thing to see. And one of the things that makes it challenging is right now, the regulatory requirement to ensure liquidity is available to the investors in the vehicles. When you're investing in an asset class, the underlying asset class is inherently illiquid. So you end up with this mismatch between the liquidity of the liability structure and the liquidity of the asset side. And liability mismatches or liquidity mismatches are a dangerous thing. So I think we have to try and start to move towards a model where people who are investing in an inherently illiquid asset class understand that it's inherently illiquid and are willing to accept lower liquidity provisions than might have otherwise been the case. Otherwise, they're almost guaranteeing themselves suboptimal returns.
Mm-hmm. All right, another question. This is from John in London, and he has a question about the SPAC boom and how it's affected your allocation to capital, and whether you see SPACs as a vehicle, as a longer-term feature of the investment landscape. Jean?
Yeah, so I would say we're not offering SPAC vehicles to our clients, but we're investing in SPACs if they represent good value. And I would say that's, again, based on the research. Do you believe in the owners? Do you believe in the people who are raising the money, that they will be good allocators of capital? So in some ways, it seems like there was a boon of SPACs. Maybe that will take a breather, but as a vehicle, it's likely to be a vehicle that will be around for a long time. And you need to know who's running the vehicle. Are they good judges of value in companies and innovation, so that you have the ability then, if you're an investor in SPACs, to make good returns over time?
But I think, Romain, the main lesson from what we've seen in SPACs is just how difficult it is for companies to go public. Right. So we have almost half the number of public companies now that we did 20 years ago. And companies, as Jean pointed out, are more and more choosing to stay private. And I don't necessarily think that is a good thing, partly until we get to democratization of alternatives. That means that excess return is being captured by institutions. So at the moment, it's very clear that the public market IPO process is not as efficient or as easy as people need it to be. And that's what's given rise, and we can argue whether SPAC is a good thing or a bad thing, but it certainly had a lot of demand, and a lot of people have chosen to take that route. And I think the lesson there is we do need to go back and make it easier for companies to go public. And I think that's going to be critical for the health of our public markets. Think I'll just add a couple of things. Go ahead. Yeah, if you don't mind. Just add to David and Jean's comments. I think the SPAC product or SPAC wrapper is a perfectly fine solution for companies. I think it was a solution that was overly exploited in the early part of this year, where there was just too much euphoria around it. I think it's a useful solution for a seller of an asset
not only because they're able to get to the public markets, but often able to achieve greater secondary liquidity than is possible through a traditional listing. They're able, as I mentioned earlier, I think, to use projections, which for many growth type companies, it's pretty hard to evaluate them without a more comprehensive set of forward-looking projections. So there are some, I think it's a useful solution. It's a useful product to have in the market that was just used, too ferociously in the early parts of this year. I think just given some of the economics around those wrappers, and that will no doubt lead to some companies going public that weren't yet ready to go public. There'll likely be some disappointments over the next few months, and I think a kind of pause here and a period of consolidation in the raising of these SPACs, I think will be healthy for the overall market.
This also raises a question here about the types of questions you're getting from clients with regards to alternative or newer assets, including cryptocurrencies and things that maybe fall outside the general purview of what we would consider, I guess, relatively safe, or I guess maybe a little bit more volatile than what you would get within the norm here. What's your general approach to addressing those types of client questions and potential allocations to those types of assets?
Well, I'm happy to start. I mean, I think that if you take again the broad picture of the economy, ever since the great financial crisis, where banks all of a sudden had much stronger regulations placed on them, the economy overall, and particularly global flows, have largely come through the securities markets, whether there be public or private. And so the overall intermediation of capital between saving and investing has never been more tilted toward investment managers and away from banks than it is now. What that's done is provide whole new asset classes. Private credit is probably the best example in all of its forms, from obviously some of the securitized pieces of it to investment grade, all the way down to direct lending. And our clients see these areas as new and diversifying potential additions to their portfolios. And they're actually very interested in finding ways, particularly given our yield environment, of putting more money to work in all of those areas. And most of them believe that this trend away from banks being the provider of a lot of that capital to the middle market is here to stay. And they are very happy to step into that void.
Anyone else?
I might add that you have both the cryptocurrency itself, sort of, whether it's a currency or a commodity, you have stocks related to that, so that's an opportunity. And then you, if you take a step back in the asset management industry and the finance industry in general, how will blockchain and other forms of this technology impact how we trade? That's something we're studying, because it could really change how trading is done. I don't think in 21 or 22, but over the long term, it's important for us as an asset management industry to see where blockchain is going in terms of how we operate as a firm. And I completely agree with David that we have clients that are interested in it, but I would say it's early days, intriguing, but early days in terms of an asset class.
Maybe just to briefly add to Jean's comments, I think it's a bit of a wake-up call when you see the pace of development for some of these cryptocurrency businesses. I mentioned this earlier, the fact that we need to move to a model over the next 5-10 years where we can deliver traditional asset management products, both traditional and alternatives, to clients in a more seamless way. Today you can open a crypto trading account by scanning a photo of your driver's license, have an account open in somewhere between 30 and 45 seconds, and be trading 30 to 45 seconds later and be selling again, 45 seconds after that. It's really raised the game in terms of clients' expectations around how we deliver products and services to them. And I think if you look at this generational shift that's going on right now, where, the Gen Z is going to overtake millennials in terms of the bulk of the wealth in this country over the next 10 years, their expectations and demands around service, customization, being able to make their own decisions on a timely and quick basis, they're embedding their own philosophy and beliefs into their investment process. I think it's all going to drive towards more customization, and that's going to require, as I said earlier, greater investment in technology. And I think tokenization and or blockchain technology will help facilitate that.
We only have a couple minutes left, but Gina, I actually want to get your thoughts on that too, particularly on his comments, Julian's comments here about some of the generational differences here. I mean, this feeds right into the whole debate about active versus passive. There seemed to be a certain generation out there, maybe my generation, that gravitated much more towards passive investing. But you're actually starting to see the newer generations, the Gen Zs, actually seem to embrace the active side maybe a little bit more than what we saw with Gen X and maybe some of the older millennials.
So, and I think that's driven a lot by what's going to happen with ESG. This generation is incredibly dedicated to sustainability around, sustainability in all aspects. And so that is an area where this generation will have higher expectations for their asset management companies going forward, in an area that I think they will be a force that will change the structure of financial markets from a sustainability lens. Just as factors have done in the last decade, value or momentum or growth, ESG factors are going to change the structure of the markets going forward, particularly as you have 5,000 companies going through their own net zero paths over the next decade. And this generation is incredibly focused on that.
All right, Gina, I'm going to have to give you the last word there. This was a wonderful conversation with all three of you, and really appreciate you taking time to be with us. Of course, Jean Hynes, she is the CEO, managing partner over at Wellington Management. Julian Salisbury, of course, global co-head over at Goldman Sachs Asset Management, and David Hunt, the CEO of PGIM. You are watching the Bloomberg Invest Global.
I welcome everyone to our next panel. I'm really thrilled for this one. My name is Danny Berger. I am anchor of Bloomberg Daybreak Europe. Joining me today is CEO of Schroders, Peter Harrison, who has a very rich history, not just at Schroders, but in the asset management industry as well, previously serving as global head of equities, head of investment, and eventually CEO at Schroders, which he's held the position since 2016. Peter, first off, thanks so much for joining us today.
Thanks, Danny. Great to be with you.
So I feel like I need to start with perhaps the elephant in the room, and that's just kind of this grim day we're seeing in markets. Stocks are selling off, bond yields are moving higher now. Peter, I won't ask exactly what you think is going on in markets today, but it is clear that there is more concern about this inflationary type environment. Is there a sense at Schroders, whether internally or from clients, that the risks that clients want to navigate are changing? And what are those risks?
Well, look, I think the world has been built on a trifecta of low interest rates, easy money, and a sense that any inflation is going to be transitory. And right now we're really starting to test that trifecta. But if the inflation piece falls over, the whole thing falls over. And to my mind, as the more inflation we see, the more worries that it's not a transitory moment in time, the more supply chain problems we see. People are going to fear that this is going to be an end of easy money, an end of low interest rates, and then you start to call into question valuations, etc. So I think it is absolutely the key risk that is on everyone's mind. There's no answers to it yet, but we should expect to see continued volatility as we work through. It's going to be a difficult time.
Does that change in terms of what clients want? Because it used to be, okay, everyone is hunting for yield. It changes the product types. Maybe they're not as interested in bond products. They want dividend payers. Is that still the story, or is that shifting at all?
No, I think fundamentally the needs of people to have return in a very low return world, and having some assurance about how that return will fare as economies shift into the next stage of the cycle, that hasn't gone away. And we all know there's a paucity of return around. So what you're seeing is this much bigger move into private markets, into private debt, etc. And I can see this, just carrying on in the same way it has done, because there aren't any easy answers.
Well, that brings me to one thing I wanted to ask you about, Peter, and that's, of course, Schroders' push into private equity, private credit. Of course, you've been in private assets for some time, but recently you had this rebrand, you've had acquisitions, you've purchased Blue Orchard. What's behind that further move into the private space?
Look, I think you're seeing a lot of client money moving towards private markets. But what's been missed so far is the intersection between these two markets. So we've had two completely different things. We've had a public market and a private market. And our premise is that over time, these two are going to move closer together and they're going to become more fungible, more tokenized. And having the ability to be able to act across those asset classes will be key to clients. I don't think we should think of the dynamics as separate. So that for us was a big change. The second big change, I think, is more profound, and it's around the fact that asset managers historically have sold a simple thing, which is about performance and risk. And there is a new chapter emerging, a third dimension, which is what's the impact? What are you affecting? What's the real external impact of the businesses you're investing in? And if you think that climate change is going to force us to build the biggest industry in the history of the world, and we've got 30 years to do it, that's a very short period from a historical perspective. Many of those businesses will start private and may well end up on public exchanges. So having impact-related businesses like Blue Orchard, which try and affect positive change, is going to be more and more important for clients. It's huge in Europe. It's growing.
So I definitely want to dig into impact investing, ESG, more. But first, I do just want to bring up a viewer question. This is Marianne from Zurich, and I feel like it fits into what you're saying, and I know you've been very vocal on this topic before. Marianne asks, how can we level the regulatory playing field regarding disclosures, requirements between public and private companies? I know this is something you recently talked to the FT about in terms of sort of leveling this playing field between the two.
It's one of the fundamental issues. If people talk about we want a lot more governance of public companies, but if you end up forcing companies off exchanges into private hands, you end up killing the goose that laid the golden egg, as we say. So to be really thoughtful, both as asset owners and as governments, to say we need to deal with this sustainability issue across all asset classes in every respect. And I think we have, I think, about 8 different consultations coming from different governments about what constitutes sustainable taxonomies. They're all going to come with different answers. They're going to create a huge amount of complexity. And bringing those together and common standards, common accounting standards, TCFD, et cetera, is going to be really important for everybody. Otherwise, we'll all spend our time making forms and not making returns for clients.
Right, and it's important for clients too, right? I was really struck by a poll that Schroders had done, which basically clients had said that greenwashing was the biggest thing standing in the way of their sustainability goals. How big of an issue is greenwashing in the industry?
Look, I think the key is going to be able to have good data. The asset management industry is being asked to produce funds which are labeled as green, sustainable, before companies have been required to produce the data which demonstrates the efficacy of them. And that's a really awkward position to be put in. So we spend a vast amount of time and effort gathering data to prove that what we're doing is good to label. But it's a challenging position because you're not dealing with real data, you're dealing with opinions. And we know the big rating agencies come to very, very different answers about what is sustainable. So this is a debate which is not going away anytime soon.
What do investors need to do from their side in order to navigate this landscape, in order to navigate ESG products, to make sure that they aren't buying into something which is just green by name only, but isn't actually accomplishing those goals?
Yeah, I think that they need to push for data. They need to push to understand what's the real underlying impact of the businesses in those portfolios, and what impact are they having on society? What are the externalities? Accounting profit is great, but we all know that it doesn't account for the real cost of carbon, the real cost of diabetes, the real tobacco. If you adjust profits for those, you get to what the real impact of those companies are. That's what they should be asking portfolio managers to put on the label of their funds, to know what the impact is.
How do you view this debate that sometimes happens around the ESG world in terms of the best way to enact change as an asset manager? Is it, one, you hold companies which maybe aren't ESG, but you push them to improve, so like a gas or oil giant via proxy votes, or just put your money and lower the cost of capital for our companies who are already doing well in these areas?
I think there's an element of both, but let's be quite clear. Forcing companies to make a good transition is going to be absolutely critical. But I think there are some things businesses do which are unconscionable, and you simply don't want them in your portfolio. So you've got to take off the tail on the left-hand side, and then work with every business which is capable of change into the middle ground. And I think that holding businesses to account, both public and private, is going to be big. But also directing capital to create new industries and new businesses. It's the innovation which is a lot of this. And we shouldn't necessarily assume that the big companies of the past can transform into the green businesses of the future. That transition is going to be very difficult for many of them.
Right. Peter, I want to shift gears a little bit. Perhaps a lot, and talk about London as a financial hub. Schroders obviously has a very rich history of being a public company in London, listing in 1959. In post-Brexit Britain, however, we have seen some of the other cities in Europe, like Frankfurt or Amsterdam, start to catch up when it comes to IPO volume. Are you concerned that London is losing its crown as a financial center?
I think that we've just recently gone through the Lord Hill review, which draws out why London has lost ground, particularly to the US actually, but also and to my mind, many of the proposals that was in the Hill review, I think will hopefully be enacted very soon, and that will help London regain its position. But we've got to be certain that there's going to be good capital flowing to new IPOs. We've got to make the opportunity for dual listed shares to be freely traded. We've got to give founders the time to grow new technology businesses. The UK's underperformed because it's full of the wrong sort of businesses. And what we haven't done is done a good job of attracting those new generation businesses to the UK. That's going to be the critical shift that's required. So the UK, I think, over 10 or 15 years is broadly flat since 1999, whereas the US is up, 250%? It's a massive difference. And that's reflected in consumers' pensions. That's not a great backdrop for them.
Right. And of course, feeds into this idea that more investors want to be in private markets, because if you want to own growing companies, perhaps that's where you want to be as well.
Yeah, absolutely. And I think figuring out how you do that well in a tough, tight regulatory environment is a critical issue. And there are a number of ways of doing it. And one of the things we've moved into private markets is because we see that as massively attractive as private assets get democratized to more people and give more people access to it. Because also people can relate better to what it is they're owning as well, because they get a share of the action.
I know you've been very vocal in terms of supporting government initiatives in order to open up private markets to different types of investors. Does it seem on your end like we are indeed getting some movement in that direction?
We are, undoubtedly. I think governments everywhere have realized that innovation is such a key part of a dynamic economy, and attracting those businesses through, and particularly, Series A, Series B's been better supported. Series C has been a much bigger problem in the UK. We have the Khalifa review, which is trying to address that issue. And again, we've launched a range of funds to try and address those specific issues and also capture some of the great businesses that are coming through. But you're absolutely right in identifying the problem, Danny.
So if we can switch back to IPOs in terms of identifying the problem, you mentioned the Lord Hill review, you mentioned some of these potential reforms like dual class structure, having a lower percentage of float. Do the reforms laid out in the Lord Hill review, do they go far enough, or are there things that you would also like to see changed and just promote the growth of capital in public markets in the UK?
I think the Hill review has got it right. I think there's a huge amount of change. What we now need to support is the patient capital required to let those businesses grow. And the UK is in a fantastic position. It's got a really dynamic healthcare sector, science sectors, technology, fintech sectors. We've got the businesses that are being developed. What's happening is they've been going overseas to list. And by just keeping them at home and driving London as a place, as a convening place, I think will work very well. But we just need to change the regulations and make it easy for them to list here.
How about the hunt for talent within London as a financial hub? There was a Bloomberg story that was perhaps cheekily titled, it was a lorry driver shortage, bankers could be next, basically saying that European Union international staff make up about a fifth of people in UK financial services industry. Is it getting harder to find that international talent and retain them in a post-Brexit UK?
I may be biased, but I think London's one of the probably the best city in the world to live. I think it's a hugely attractive place for people to come to get educated and a series of vibrant sectors, whether it be the arts or finance, and that brings people to London. So we're not having any trouble of attracting people here. In fact, to my mind, the frustration is that the stock market isn't reflective of the very dynamic financial sector that we've got, and that's actually closing the gap. Because if you look at every other measure, in other financial sector, in other parts of the finance world, the stock market is not a good reflection of that. We're doing far better from a debt perspective, from an FX perspective. So I'm a huge fan of London.
Well, as am I. I've been here for 4 years, and I'm probably not going anywhere anytime soon, so I can definitely sympathize. I want to talk, Peter, about Peter, I want to talk about Schroders in terms of strategy of the overall business. There certainly have been quite a few acquisitions that you guys have made. We talked about Blue Orchard. There's, of course, Sandaire, the multifamily office as well. How key are acquisitions to growth at Schroders?
I think it's part of bringing in new capabilities. So, to my mind, we started life with a traditional asset management business. We've grown a big private markets business. We're growing a big wealth business, and those two things help accelerate growth and help spread our expertise across more sectors, get us closer to the end consumer. And they are slow to grow organically. So by bringing in a capability and able to launch the next generation of funds and integrate it in is a much quicker way to attain that growth. So they're not seeking to do transformative acquisitions. We've always shied away from the big mega merger, which has seen elsewhere in the sector. We'd much prefer just to focus on capabilities, and that's driven good earnings growth from those and good follow-on growth.
Does that mean we could perhaps see some more of these types of acquisitions that expand capabilities at Schroders in the near future?
Yeah, absolutely. Absolutely. I mean, we see it as a really good way of getting closer to the markets we want to get and just taking incremental steps. And it's a good source of earnings growth for our shareholders.
What about the industry as a whole? You mentioned the mega mergers that are happening. How much consolidation do you foresee in the industry as a whole?
I certainly expect to see a lot more, but not with asset prices where they are, because this is an easy time. Rising tide lifts all ships. But when we see lower markets, which may well happen, you will see that as a moment where people are forced to look at their cost basis. And if you haven't got growth, the answer is cost reduction. To my mind, the secret is investing very heavily in growth when the sun is shining, because that will see you through those difficult periods. So I would expect to see, we saw a transaction with NN being bought by Goldman Sachs earlier in the year. I would expect to see a lot more of those. But to my mind, the business is about growth, not about cost reduction.
And Peter, back in a former life, I used to be an ETF reporter, so you'll have to forgive me for this question, but I feel like I have to ask it. How much of consolidation in the industry is being driven by competition of low-fee passive products and just trying to reach those economies of scale to kind of meet the low-fee environment as well?
Yes, it's exactly the right question. I mean, if you think about it in terms of disruption, a product has come along which is nearly free, and there's a great price war going on in ETFs, which is pushing the price ever lower. And active managers have got a value proposition which is at a higher fee, and that's forcing change. It's forcing the price of active management down, and is saying, unless you've got very high quality alpha and very good investment performance, there's a cheap, nearly free alternative. So to my mind, that's going to go on a lot longer. The key, to my mind, is as an active manager being able to outperform. And I'm very fortunate that I work with a bunch of investors who've been able to make over 80% of our funds outperform over pretty well every time period. So that puts us in a very strong position. But we've invested very heavily in data insights, et cetera, to achieve that performance.
That is exactly what I was going to ask, because I was looking at some Schroders stats before coming in here, outperforming over 1, 3, and 5-year horizons. Also seeing inflows in the first half of the year when a lot of your peers have not. I mean, it's a difficult market environment to navigate. What do you attribute that to?
Look, there's a couple of big things happening. And we talked about sustainability and the fact that clients are demanding a different type of product. And we've been very fortunate that we're leaders in that area. They also want more thematic funds, which tell a story, which, you can invest in climate change, invest in disruption. Nobody wakes up in the morning wanting to beat the MSCI Europe or another index. So they want a product they can relate to. Institutions want their problem solving. They don't want us to say it's just about alpha in this narrow market. Solve my whole problem. Solve my Solvency II problem. And it's the firms that are able to do those more difficult things which are gaining a lot of share. And I think what you've seen in the last 12 months is the haves and the have-nots are polarized very significantly. And you've seen very good growth in some areas and very poor growth elsewhere.
So where are those sort of good growth areas then?
Well, I'd say sustainability, thematic solutions, wealth, ETFs, partnerships where you can get close to the end client. And we've got a great joint venture with Lloyds Banking Group where you can really drive growth through direct relationships with customers. You saw it with Morgan Stanley buying into Eaton Vance and E-Trade. The same trends are evident across the Atlantic. But those businesses with growth get stronger, and those that aren't in those bits of fast-flowing water are struggling to get traction.
All right, Peter, I'm afraid that's about all we have time for. It was such a pleasure speaking with you today. And I, of course, want to thank as well everybody for joining and listening. And again, thanks.
Danny, thank you.
Good morning, and thank you so much for joining us. I'm Tim Stenovec. I'm an anchor for Bloomberg Quick Take and Bloomberg Business Week Radio, and I'm very pleased to be joined by Gina Martin-Adams. She's Chief Equity Strategist for Bloomberg Intelligence. It is great to have you with us, and this is a perfect day, Gina, because we've had 5 straight days where the S&P 500 has changed directions from the previous day. Today is shaping up to be a 6. They've also been big moves. I'm wondering what exactly is going on with volatility, because we've seen 5 days in a row of more than 1% move. So what's up with this?
Well, I think there's a lot going on, Tim. First, thank you for having me. Lovely to be here with you today. In terms of volatility, one thing to just consider is seasonality. October is typically a very volatile month. We all think, of course, of major crashes in the past, which shall not be named. But nonetheless, what you typically see is a market that is very weak in September, followed by an average market in October, but a characteristically very volatile month in October. I think also it's really a follow-on of what we've experienced over the last several weeks. Really starting at the beginning of September, investors just had this plethora of issues to contend with inflation pressures lasting a little longer than expected, certainly Fed policy shift on the horizon, a lot of concern over what's happening down in Washington with respect to government shutdown and now debt ceiling. There's just a lot to consider, and these moving parts are creating some degree of volatility, which we frankly hadn't seen in so long. It feels a lot worse than maybe it really is.
So buckle up for Q4?
I do think Q4 is going to be very interesting because all of these issues aren't necessarily going to go away. And certainly one of the biggest issues that we've been watching really carefully is what's happening with earnings forecasts, what's happening with earnings results or likely to happen with earnings results amid all of this risk. And certainly it's taken a back seat to a lot of the more exciting headlines with respect to policy changes coming from either the fiscal or the monetary body. But frankly, this idea that inflation is sticking around for a little longer than many analysts had forecast is likely to be the big takeaway from the third quarter earnings season coming up. And we're starting to see that reflected in expectations.
Okay, so talk a little bit about that, because in a recent note, you write that inflation is sneakingly chipping away at an optimistic outlook for the S&P 500. Why do you think that investors should pay more attention to inflation, especially when policymakers are saying it's not going to be around forever? this is something we think is going to be transitory?
Yeah, it's a great question. I think we need to pay attention to it for a number of reasons, but most profoundly in the short run, we need to pay attention to it because even though policymakers are telling us it's not going to be around forever, it is still sticking around for a little longer than anyone had anticipated, at least in the short run. And we're seeing that reflected in analyst expectations. So far, roughly half of S&P 500 company estimates for operating margins, which is the manifestation of inflation pressures in the earnings stream, those estimates have dropped for third quarter and for fourth quarter season. We've not yet seen a downdraft in the forward 12-month outlook, which I think we want to watch for, but it is starting to chip away, and that's having pretty meaningful impact on price, where the companies with the greatest downward estimate revision to margin expectations are experiencing price pressures.
Could they then pass on those price increases, that margin pressure to consumers and then not see that margin pressure? Do they have that pricing power?
I think for the most part, no. And that's what we're seeing reflected in the estimates is what we're seeing is top line estimates are not moving. Top line estimates are actually still rising net for most of these companies. They're still experiencing very, very strong revenue growth, but they're unable to pass along the price increases in total because their bottom line estimates are moving lower. So we know for sure that what's happening is somewhere in between revenue and EPS, we're starting to experience some pressure. It's not by any stretch of the imagination pervasive. It's not every company in the S&P 500 experiencing distress, but it is about half of them, at least in terms of analyst forecasts, experiencing a little bit more in distress than many people had anticipated for at least the next quarter or two.
So inflation and monetary policy, associated monetary policy, it gets a lot of attention right now. But you recently argued in a Bloomberg Intelligence note that fiscal policy deserves a lot of attention too. How should investors be thinking about margin pressure and equity returns if Democrats do succeed in raising the corporate tax rate?
Yeah, I think this is one of the most profound considerations that people are sort of just pushing to the sidelines. We saw this happen in the reverse in 2017, 2018. Markets certainly started to price for corporate tax reform at that time, but analyst estimates really didn't move. Analyst estimates, in fact, didn't move until December of 2018 after the tax policy was passed. In that period of time, we saw net income margins on the S&P 500 jump 200 basis points because of that tax decline. Wow. It's a huge margin boost that we experienced. We have not seen analyst estimates change at all for net income margins. Only the operating margin component of that is changing. We're not seeing any sort of imputed expectation for higher tax rates going forward. The result is if we do get to corporate tax reform, in my mind, we have to have a repricing of the earnings stream. Now, what will that tax reform look like? I think there's a lot of question marks, and this is one of the reasons why we haven't priced in a lot. We don't know if we're going to get a spending package, a fiscal spending package that needs to be funded by tax reform. We don't know what rates those taxes are going to come in at, but nonetheless, we will have to price a tax increase if we see corporate tax reform, and that's going to get reflected in a downdraft in net income margins, which we haven't seen on the S&P 500 in quite some time.
Would any of that be offset with economic growth that comes as a result of these packages that are trying to make their way through Congress?
I think that's a very reasonable assumption that we could get some offset. But when we run through the scenarios, we take, say, 50% of a potential infrastructure package actually impacting S&P 500 revenues over the course of 3 years. And we impute an assumption for the corporate tax rate coming in somewhere around 25% effectively. And the net result is still a drag on S&P 500 earnings. That tax rate makes a very meaningful impact. Now, you have to make a lot of assumptions, obviously, as to the efficacy of fiscal spending and a multiplier effect on the economy. But nonetheless, I think 50% bump, or 50%, if we assume 50% of that goes directly to S&P 500, that's a pretty optimistic assumption over even just 3 years. So you could see a much bigger drag than even our scenario analysis suggests.
Okay, well, back to monetary policy from fiscal policy and talking a little bit about the more hawkish tone that we've had from central banks around the world. As the Fed begins to think about tapering, give us some insight into the relationship between the Fed's balance sheet and what historically we've seen when it comes to returns in the S&P 500.
Yeah, really intriguing, almost one-to-one relationship between what happens with the Fed balance sheet and what happens with the S&P 500. I'm oversimplifying, of course, but nonetheless, we have seen when the Fed balance sheet is accelerating, the S&P 500 returns tend to accelerate. And the opposite happens when the balance sheet is no longer accelerating, or even when the balance sheet has flatlined, the S&P 500 has entered a period of distress. This is a very tried and true relationship that developed over the course of the last 10 years or so. So there's natural jitters that have evolved as a result of this potential taper. I think there are still a lot of questions as to what the taper looks like and when interest rates are likely to rise. And these questions have really started to bubble up starting this summer. And we're starting to see that reflected in sector movements and factor movements in the S&P 500 already. But historically, what tends to happen, or at least what happened over the last 10 years, is a taper is not necessarily meaningful. It just means that the balance sheet is likely to rise at a slower pace. The S&P, therefore, you could make the broad assumption or the wide sweeping assumption that it would then rise at a slower pace as well. It's really those periods of time when they stop purchasing assets or even start to shrink the balance sheet that have been difficult for stocks. The other aspect of it is what happens with interest rates. And when interest rates go higher, what's the meaning behind that? I think this is a really challenging situation at large because the combination of monetary and fiscal policy together are now roughly 60% of GDP. And then we sort of take a back seat on this and think about just where we've been over the course of 2020. We've had such remarkable fiscal and monetary policy infusions. Backpedaling from that environment is inevitably going to be challenging.
Hey, Gina, I want to end with just thinking about holistically where we are when it comes to the U.S. economy, because you use the economic regime model at Bloomberg Intelligence. Explain what that is and really where that leaves us as we get into Q4 and head into 2022. How's the U.S. economy doing?
So we've taken a view. We try to take a view on where we are in the economy to derive our expectations for potential market returns. The economic regime model is one of those ways in which we do that. We've developed a logistic regression that really analyzes just a small subset of economic indicators that are very meaningful for deriving expectations for the economy. And it rates the economy on a scale of 0 to 1. Typically, the economy is somewhere very, very close to 1, running very, very fast, moving forward. It's been extremely hot from spring of 2020 to today. It's been running very close to 1. As of August, it likely peaked, and we've started to see the economy edge off of that peak rate. Does it mean necessarily devastation? We're nowhere going to 0, which is effectively recession. No, but it does mean a slowdown in economic growth is likely, and the natural result of that will likely be a slowdown in your expected rate of return for the S&P.
Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. A great conversation. Thank you so much for taking the time. Stay with us for more of Bloomberg Invest Global.
Hi, welcome to the SPAC panel. My name is Crystal C. I'm a deals reporter at Bloomberg covering IPO, SPACs, and M&A. Joining me today is Betsy Cohen. She is the chairman of FinTech Masala. She has raised 9 SPACs, and 6 of them have announced deals. She focuses on FinTech. One of the busiest sponsors out there, some of the companies she took public include Perella Weinberg, Payoneer, and eToro. Welcome, Betsy.
Thank you. Thank you very much, Crystal.
Yeah, well, we're so many times, and throughout the 2 years from the beginning of the SPAC boom, which is probably when Virgin Galactic went public, like things have really changed. We're kind of 2 years in. Like, where are we in the SPAC market right now? People like to say there is a SPAC bubble. Is there one? Like, are we coming to an end in this SPAC world?
I think we're coming to a middle, not to an end, because I think looking back over maybe a 20-year period that IPOs and other instruments have had cycles, and I think SPACs are no different. The SPAC is made up of several components, and so you do have the public market, but you also have private investors who are looking to establish positions without running the price up and therefore participating in the pipes. And so if they believe that the market is soft and they can buy on the public market as easily as investing in a private investment for public equity, that will cause a diminution in the number of pipes that will be actually completed. We'll see some failures, and the cycle will then cleanse itself, and we'll move to a new point in what might be a deflated SPAC bubble. But really focusing primarily on the ability and experience of the SPAC sponsors who were left.
Right. So you're saying that we're kind of in the middle. I wonder how much time do we have in this wave, like until kind of pipes get way too difficult or that public investors just are no longer interested?
It's really hard to predict. I would say that we'll have some portion of the shakeout within the next year. But it really depends upon the cycle of the greater market, their macro trends that really push this along as well. If, in fact, there is tremendous interest, not so much in fintech, but maybe in biotech, then biotech SPACs will move forward. It really is not a single asset class. When Virgin Galactic got completed, it was the first of a series of what I'll call dream SPACs, where the public market and even the private investors wanted to believe that something very special was going to happen, even though it was hard to be grounded and predictive of what might happen and the time frames for it, because it hadn't happened before. The same phenomenon is occurring, has been occurring, or was occurring with electric vehicles. So there are dream, and they are one asset class, I would say, dream SPACs that may have begun with Virgin Galactic.
Right. Yeah. So these like pre-revenue SPAC, like you said, the space tourism, the electric vehicle, the flying taxi, have most of them like fallen out of favor with investors, let it be pipe investors or like public investors or even retail investors?
I think the uncertainty of the predictability, which is really what SPACs are based on. You can provide investors with a look forward in a company that's growing quickly, but it has to be based on something. And in these segments that you've just mentioned, it's very hard to time those predictions. And so people get disappointed. They therefore pull back. Something wonderful occurs, and they go forward. So there are a lot of macro trends which fall underneath the success or failure of what we'll call the dream SPACs.
Right. And you talked about kind of prediction, which is one of the most unique element of the SPAC. It seems like the SEC is a lot more vocal about kind of estimates as well as other potential regulation that may come. What do you think like scared them, the regulators, and kind of where do you think this regulatory landscape is going to look like in a few months or in a year time?
Well, I think when the regulators began to look at SPACs, there were many, many fewer what we're calling dream SPACs. So that most of the SPACs were based on some historical and potentially more predictive, certainly in the fintech area, predictive models. As you added less predictive models, the SEC recognized that they perhaps had not been looking at the prediction criteria as strenuously as they could. And so I think appropriately, they're now digging in and taking a harder look at, are these numbers just made up? Did we pull this out of a hat? Is this what we want to happen? Or is this actually an extrapolation, as usually is the case in the fintech area, of what has occurred in the past?
Right. So it seems like you think their SPAC market should be divided into two, like the dream SPACs and like the non-dream SPACs. And so if I were a retail investor, would not, I don't have like millions in my portfolio, kind of how do I know like what sponsors to back and like how should a retail investors pick and choose like what deals they want to participate in?
I think it's tough. I don't think it's an easy thing to do. But I think you have to look at a sponsors and retail investors. We're not looking at sponsors, but you have to look at a sponsor's history. Certainly if someone has done multiple SPACs, they should know more than someone who's doing it for the first time. Doesn't mean that first-time issuers are not good to look at, but you'd have to take it with a grain of salt, as you do in every business. So there's some history, some success record or lack of success. All of those are publicly known facts, but tough for the retail investor to access.
Right. And in terms of like serial SPAC deal maker, you yourself are one. You've raised 9 SPACs. Some sponsors out there are saying they want to do things alphabetically, go from A to Z. I wonder, what is your end goal? Like, how many SPACs do you think you would do? Like, what is the end game here for you?
The end game is finding good companies and taking them to the public market when they're public ready. And so we're very, very dull and boring in that we really are looking at fundamentals. We're in an area which we know. We've been operators and founders in this area. And so we continue to search on behalf of investors for good companies that will make good private companies that will make good public companies.
Right. And a little bit of a more technical question is, we have seen in the SPAC world very high redemption lately on some transactions, as in investors don't want to participate in a deal and they choose to redeem their $10, their cash back instead. Is this a sign from the market that, we don't need 400 SPACs out there? Like, what do you think of the fate of these more than 400 SPACs out there finding targets today?
Yeah, I think 30% of them will fail. Maybe that's not exactly the right number, but, in the neighborhood. Because they won't be able to find companies within the time frame, or they will find companies within that time frame, but the public market investors will not support them. Traditionally, the pipes have been done to validate valuation, and that's not happening as much today. You see private equity funds that are both the pipe investor and the private equity and the sponsor investor, and so you have an inherent conflict there, which probably is not a good thing. And public investors are very quick to understand that the valuation hasn't been validated by anybody except people with an interest in completing the SPAC.
Right. And in the beginning of this SPAC boom, there seems to be this concept that if you do a SPAC, you may get a valuation arbitrage. You may get a higher valuation compared to if you go public through the IPO. Is that still true? Has that ever been true?
I actually don't think it has been true. I think that there are instances, as there always have been, with or without a SPAC market, where IPOs are priced at a point where the deal can get done unquestionably, but the company is actually leaving a lot of money on the table, and the stock then pops because the valuation is in fact higher than the pricing. This has been a phenomenon for a long period of time, and if in fact you don't have that validator, as we have over the last couple of years of valuation, then you're going to have people in the public market, retail as well as non-retail, who are concerned that they're overpaying and therefore going to redeem. The redemption is really done because they see that they have earned as much with what is in the trust as they would have if they put it into a savings account in a bank.
Right. And more about you, Betsy. There has been so many exchanges and regions out there, Asia and Europe, that are trying to introduce the SPAC into the local exchanges. Would you be interested in raising a SPAC outside of the U.S.?
Absolutely. We think that certainly the pandemic showed us without question that within tech and fintech in our areas, that the world is really one. And so we're very interested in pursuing European, Asian, Singaporean, whatever the appropriate regulatory framework is, where there are companies that are growing and doing exciting things. And that can be any place in the world.
Right. And that's for the target, but will you raise a SPAC that's kind of like listed elsewhere?
Yes. I'm sorry. I was really also talking to the opportunity to raise, the U.S. markets are the most liquid. So it's, and often the targets want to be on the U.S. markets. So it's a matter of finding the right target who is comfortable on maybe a newer and less tested exchange.
Right. Well, the last question before I let you go. Almost everyone have a SPAC these days. Is there anyone out there who you think is qualified but still haven't raised one? And you think, there you go, you should raise a SPAC too?
I can't think of a single person. Everybody and everybody's brother-in-law have raised a SPAC now. And so I think it's about time to focus on experienced sponsors.
Well, great. Well, thank you for joining me, Betsy. That's Betsy Cohen, Chairman of FinTech Masala.
Thank you very much.
Hi, everyone. My name is Anna Paglia, and I'm the Global Head of Invesco's ETF and Index Strategies business. I'm here with Ryan McCormack, our QQQ strategist. We are delighted to be expanding our partnership with Bloomberg for another year in the Bloomberg Invest series of events. Many of you know Invesco as one of the world's largest asset managers, and Invesco QQQ as one of the world's largest ETFs. An ETF that has enjoyed over 22 years of live track record. In those 22 years, we have seen quite a bit of change. The parabolic acceleration of the digital age, 5 different US presidents, 3 recessions, 1 pandemic. Yet all the while, Invesco QQQ and the companies within the fund continue to innovate through it all. We have strengthened our already deep relationship with NASDAQ, as Invesco is the only asset manager that has funds tracking the NASDAQ 100 index. And we have expanded into new and exciting relationships, perhaps most notably with Invesco being the official asset manager of the NCAA and QQQ being the official ETF of the NCAA.
Invesco QQQ tracks the NASDAQ 100 index, comprised of the 100 largest companies listed on the NASDAQ exchange, ex-financials. From its beginnings in January of 1985, the NASDAQ 100 has blossomed into the preeminent large-cap growth index, offering investors exposure to some of the most innovative companies on the planet.
And innovation is not just a word. Innovative is not just an aspirational claim. Innovation is real only if you can quantify it.
Now, although quantifying it isn't exactly a perfect science, since an innovation metric doesn't really exist, but we believe a good place to start is a company's commitment to reinvesting back into their businesses through research and development spend. We found that companies within QQQ and the NASDAQ 100 spend more on R&D than many of their counterparts, which we'll outline further during our panel discussion later in the program.
I agree, Ryan. The commitment to R&D fuels innovation and has propelled QQQ companies to be leaders as well as early adopters across a number of transformative themes. We have seen many of these QQQ companies stay ahead of the curve over the past 2 decades, consistently identifying and cultivating products, services, and trends that have become widely adopted and in some cases indispensable. In the past year, we have seen QQQ companies collectively file a considerable percentage of patents relating to themes that are already part of our daily lives. Cloud computing, cybersecurity, wearable technologies, and big data, just to name a few.
And they file patents among themes that may be a very big part of our future, like spacecraft and satellites, human augmentation, blockchain, and autonomous vehicles.
The foresight from these QQQ companies have placed them squarely in the middle of solving complex issues. Look no further than Moderna over the last 18 months and their phenomenal work fighting COVID-19.
Moderna was a relative newcomer to QQQ. It joined in July of 2020, and since then has obviously made quite a splash. Its addition to QQQ coincided with its rise to prominence as the maker of one of the first mRNA vaccines approved by the FDA under its emergency use authorization. This likely is just the first step towards changes in the way that we combat disease. Gene mapping, bioinformatics, the use of nanorobotics, advanced immunotherapies, all will likely transform the way that we diagnose, treat, and cure diseases in the near future. QQQ companies are active participants in this transformation.
And the treatment of disease and disease prevention aren't the only big global problems that QQQ companies are fighting.
Yeah, far from it. QQQ companies are firmly entrenched in the world of artificial intelligence and machine learning powered by big data analytics. This stretches far beyond healthcare. It's actively being used in predicting and hopefully altering climate change, urban planning and traffic mitigation, energy usage, delivery, and efficiency, making both the world that we live in and the digital world safer and more secure, exploration beyond our planetary borders, and so much more.
It is incredibly exciting to hear about the potential opportunities of growth that exist for companies within the QQQ. To take this a step further, we believe that Invesco QQQ also creates an opportunity for every investor to become an agent of innovation. We would like to say thank you to Bloomberg for the opportunity to expand on our solid partnership, and we hope that all attendees enjoy the rest of Bloomberg Invest.
Hi, everybody. I'm Shonali Bassick with Bloomberg Television. I'm the Wall Street reporter for Bloomberg. And with me, I have Kewsong Lee. He is the CEO of Carlyle, and he's been the sole CEO for just over a year now. He has a goal of reshaping Carlyle into a more modern institution, and they are making a lot of changes over there in the past year. We are missing Marcy Frost today, the CEO of CalPERS. However, we'll still be speaking to a lot of the initiatives that CalPERS and Carlyle are embarking on together. Q, thank you for joining us. When we think about what you have done here with CalPERS, what you have done is gather more than a dozen institutions, private equity firms, and pension funds, some of the biggest in the Americas, and said, we're going to make data available that was never seen before. That is data tied to emissions. That is data tied to diversity. And the goal is to ultimately track progress in those arenas. What kind of feedback have you been getting in the week that that's been announced? And what kind of progress do you think that can be created from such an initiative?
Well, Shonali, first of all, thanks for having me. It's great to be here. Look, it's a terrific initiative that CalPERS and Carlyle are leading, but really it's not about any one firm. It's about collective action in the industry, because only if we can all come together, contribute data in a way where we can create common language and perspectives that cut across in a standardized way, can we actually start to make real progress, track that progress, and have benchmarks so that we can all improve on ESG matters. Since the announcement, it's been terrific. Over 100 GPs and LPs have already contacted us and wanting to join. And the more that do join, the better this initiative will be. And so I invite all LPs, all GPs to want to take part. This is good for ESG. This is good for business, and it's good for the industry. It's a first step. There's a lot more to do, but we're really, really pleased with the reaction and really the excitement of folks wanting to join and come together in a collective way so that we can make improvements.
Now, it's not often that you see rival firms get together and share information about their companies, right? What is the incentive that they have to do this with you in order to make a move that really, at the end of the day, may dictate where capital goes based on ESG initiatives?
Well, look, it's not really about any one firm. It's about all of us. And I think it's fair to say the obvious, the environment is shared by everybody, right? So we're all trying to make a difference. But it's also good business for us to do this. And I'll tell you why. You know, right now we have different types of data requests coming in from different types of LPs. We have GPs that are tracking different data metrics, contributing it in different formats in different ways. And quite frankly, none of us can make sense of the data despite all of our good intentions, because it's not a common standard and there aren't well-defined metrics that we're consistently tracking. And so for us all to be able to come together to do this, it only just makes each and every one of us in our industry better. And so there's a self-motive, we're all self-interested here in the sense that this actually improves performance. And I know at Carlyle, this is a cultural thing. It's a mindset thing. We're trying to drive better performance at all of our companies because in our view, if we build better companies, they perform better. And if they perform better, we can drive better performance and returns for our LPs.
Yeah, this is interesting. This is data you're going to be sharing about portfolio companies, but Carlyle itself has gone into many of its own ESG initiatives, tying comp to diversity initiatives, incentives tied to diversity goals. Can you speak a little to how you are seeing these changes from a business perspective? Why is this so important for you to do? And what has it meant in terms of either talent retention or attracting more capital? Tangibly, what's come of this?
Sure. It goes back to what I said, which is this for us is cultural. It's a mindset. We can't talk about ESG as just a topic or a check the box with respect to diligence. And the reason I say it in this way is if we're focused on driving a mindset of trying to improve everything we do, and we at Carlyle have to hold ourselves accountable to that as well, I think it drives better decision-making and better performance. So, some examples of that. In terms of diversity, we have over 50% of our AUM led by women. We have unconscious bias training for all of our employees. Over 80% of our employees go through that training. At our portfolio companies, we're putting more diversity into our boards of our portfolio companies. Just a recent stat, first 6 months of this year, 60% of all of the board members that we've introduced to our portfolio companies are from diverse backgrounds. We're putting in credit facilities at our portfolio companies, which are linked to improvement in ESG matters. So for instance, we have one company where if they reduce their water usage, their cost of capital comes down. Or at Carlyle, we have subscription facilities whereby if we can improve diversity at our portfolio companies, Carlyle's cost of borrowing goes down. And then of course, with respect to compensation and career tracking, we've implemented throughout Carlyle that this is an important element in the discussion as to whether or not you get promoted or what your bonus is going to be. You can't rely on one silver bullet. You got to have a lot of different actions. You can see from what we're trying to do, we're integrating and taking an approach that this isn't just a topic where we're trying to cosmetically say, let's make a few demographic improvements and show some initiatives. What we're trying to do is integrate into our culture and integrate into our mindset, integrate into our approach. Everything we do has to be about driving better performance and improving companies so that we can perform, and we hold ourselves to that same high standard.
Right. Now, Q, the thing that's interesting as well, Marcy had previously told me that employee engagement, which is one of the metrics that you're using in this data reveal, is going to be a big factor in how she invests in companies because she believes that better engagement means better performance. Now, for you, how does that play out in terms of the return to work conversation? Because you've made some interesting decisions in terms of slow walking that return to office vis-a-vis your peers, as well as giving employees a full week off in August for the means of their mental health. And so, do you think that Wall Street is rushing it at the risk of losing talent? And why are you taking such a measured approach?
Yeah, well, I'm not going to comment what others are doing, but I can share with you what Carlyle is doing. And I'm really proud of our team and how we've managed through this crisis. We're fortunate. We have close to 30 offices in 5 continents, and we've been seeing this pandemic and the impact in different regions, different cultures, different offices, and we're learning from each other and sharing information so that we can try to figure out what the right answer is for us. I can tell you here in the States, we've embraced hybrid. We've mandated the vaccinations. We have been very transparent with our employees throughout this period of time, and we've communicated well to our people, and we've established trust as to how we're thinking about things, what we know, what we don't know, and we're all working so well and under such a difficult circumstances with respect to remote work. I call it living at work. I don't call it work from home. And as a result, we've established this trust, which has enabled us to communicate very well and get our people back into the office in a hybrid type of an approach. We successfully opened our New York offices and our DC offices several weeks ago. We've now hosted parties physically, cocktail events with our limited partners, and have now interacted with them. All of this has gone great, and I do think it's really important to have a physical connection with relationships with respect to building culture, the mentoring, what younger folks want in terms of trying to understand the nuances of their jobs. But it's also really important for problem solving and creativity. And people have talked about all that. But Shonali, I'll point out, I really think if you do it right, virtual environments can be very good for culture as well. We have now, in certain meetings, people from all over the world in a very flat and lateral design where they are speaking up. Voices are being heard that have never been heard before. The amount of inclusivity that you can have and increase that participation with folks and get different perspectives to the table is made that much better if you use the virtual environment in the right way. So I think it's all about leadership, using the physical environment the right way, using the virtual environment the right way. That's why we're embracing hybrid. But I do think if you do this the right way, you can adapt and you can be better at what you do, and that's what we're pushing for.
Speaking of adapting, we are at such a tense point in markets today. There are risks mounting by the day when it comes from Washington to China. So on top of your list of worries, what concerns you most about the trajectory of the investment environment?
Yeah, the investment environment, no doubt, is incredibly complicated right now, and navigating it is going to be a challenge. But we've been in this for many decades, and we have a long-term perspective. And I think it's important to understand that where there's volatility, where there are complications and complexities, there's also huge opportunity. And if there's one thing I've learned with respect to the challenges over the past 2 years, Carlyle is able to pivot and move to opportunity incredibly well because of our platform. So if you have kind of a global perspective, deep industry expertise, and an ability to do buyout deals and growth deals, an ability to think about private equity and private credit, an ability to think about real estate as well as infrastructure, you now can see that that's the playing field we have where we can pivot to and move to where the opportunities are going to be in light of all of the complexities you're seeing. Some of the things that I am worried about or we're very focused on, if you think back a couple years, accommodation, the fact that there was fiscal spending, and then the resurgence you saw off of controlling COVID, are now probably going slightly in the other direction, right? The Fed's talking about tapering, so you could see, it's still going to be accommodative, but maybe a little bit less accommodative. Certainly the fiscal spending, everyone's talking about that right now. Not so sure it's going to be as large as people initially thought. And then the bounce back of the economy, certainly it has bounced back, but it is decelerating. It's growing, but not as fast of a rate as it was 6 months ago or a year ago because of the bounce back. All three of those things are potential headwinds. Now, you have to balance that, though, Shonali, with the fact that technology is creating real change, business models, new companies that are disrupting, as well as incumbents that are embracing digital and technology to create opportunity and drive better performance. All is creating enormous opportunities around the world. And so it's appreciating both is really the key here.
Well, there's a big debate about deflationary trends versus inflation, of course, which we're seeing much of now. How much does inflation concern you in this world right now?
A little bit of inflation is not the worst thing in the world, and we are very focused in on it. But I'm much more worried about the impact on interest rates and valuation multiples. Certainly, asset prices are incredibly high. You're seeing that driven for a whole bunch of different factors, one of which is very, 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 very low interest rates. And to the extent that transitory price pressures become a little bit less transitory and gets built into inflation expectations, and to the extent that through policy or other things you see rates start to back up or valuation multiples start to come down, you could see corrections. Certainly China has already gone through a bit of a correction. We may be seeing a little bit of that right now. Who knows? But look, we're in the long-term business. Whenever things like this happen, it creates opportunity. Personally, a healthy correction is not necessarily a bad thing. All expansions need some type of healthy correction to ensure that excesses are restored, that balance occurs, and that some crazy behavior gets pushed out, right? And so, I personally, while it could be painful, a healthy correction is not necessarily a bad thing.
So then do you think that right now is a good time to be selling assets given where valuations are?
We're lucky. We're always selling and we're always buying, right? Valuations are high, and we're going to take advantage of that in certain sectors, certain companies, certain investments that we've held. But at the same time, like I told you before, we see enormous opportunity, and we're putting more money to work and investing in regions and in industries that we find incredibly attractive. So again, the benefit of our platform, we're always selling, we're always buying, but make no doubt about it, when valuations are high, to the extent that we can in our portfolio, we'll take advantage of it.
Now, I'd be remiss if I didn't ask you about some of the challenges in China, given kind of your work you do outside of Carlyle on many different advisory boards. What is the biggest concern in the environment among your clients and peers right now that you're seeing? What advice do you have for anybody that is looking at the crackdowns in China?
Sure. Well, it is one of the most important issues of the day, obviously. My perspective on this is, and clearly there are some, and I've described it this way, some short-term bumps, but that region of the world always has some short-term bumps along the way. But the bigger picture, when you step back, and when I talk to CEOs and CIOs around the world, they're underexposed. They're underallocated to that region of the world for what that region of the world represents to the global economy. And so the question isn't, should I be investing in that region or not? It's really, what's the best way and how should we be doing it? And in my mind, I think there's more opportunity in that region of the world than not, especially since valuations have corrected a bit in that part of the world. I do think the mindset needs to be one of very long term, to be consistent, and to be committed. You cannot, it's not a region where you can go in and go out, go in and go out. It's a region where you have to appreciate the bigger picture, how important it is to the global economy, how essential it is in a modern day, well-constructed investment portfolio, and then thoughtfully think about how do we consistently invest in that region of the world with the best partners so that we can take advantage of the investment opportunities there.
Now, we only have less than a minute here, but I want to get your opinion on the debt limit, because we are seeing the bank CEOs go to Washington or attend a virtual meeting today. What concerns you?
Well, I think it's the politics and the rhetoric. When I go to Capitol Hill, and I just came back from D.C., and I meet with both sides of the aisle, everybody appreciates and understands that, of course, we're going to have to raise the ceiling. Yet the politics and the rhetoric are getting in the way. I am very confident our policymakers and our leaders will figure out the right answer here. Exactly how they do it or when they do it, my crystal ball is not that good. But I'm not as worried about the debt ceiling and that not being resolved. I think it will be. It's just a matter of when and how.
That's Kewsong Lee, the CEO of Carlyle. Again, just over a year into his tenure as the sole CEO. Thank you so much for your time and hope to talk to you again soon.
Shonali, thank you very much.
Hello and welcome to this 5-minute spotlight session on the investment environment and opportunities in Angola. Today I have the honor of speaking with Dr. Antonio Enriquez da Silva, who's the executive chairman of APEX, Angola's investment and export promotion agency, as well as with Mr. Otoniel dos Santos, who is the Secretary of State for Finance and Treasury of Angola. My first question is for you, Antonio. Angola has registered a total of 396 investment projects from August 2018 through to July 2021, budgeted at $4.2 billion US. What do you think is behind the recent increase in investor interest in Angola?
Well, first of all, thank you very much for this opportunity to share our Angolan story. And I will begin by saying that they are mainly due to the ongoing reforms, especially to the political ones, and not only because the impact of the political ones had was a major boost to all the other reforms that are on the economical side. And having said that, we also had strategically in place a set of programs directed to diversification of our economy that have improved the level of participation of investors. And also, we also noticed that from the existing set of investors, they had switched from trade and other services to a more risky kind of operations within the manufacturing sector. And that has given us a strong sign to investors, foreign investors, that Angola, as part of the reforms and as part of the anti-corruption campaign that's been driven by our government, has improved the kind of assurances that investors seek into a new market. And Angola also has a strategic position in the continent, and the infrastructure that is being built will enable us to not only play a role as a country, but also to be part of a much broader setup within the African continent.
Wonderful. And Secretary Otoniel, one of the perceived risks of investing in Angola has been the shortage of foreign currency in the country and the issues that can cause. How is the government responding to this, and what guarantees are in place for investors thanks to the new investment law?
Thank you, Nikki. Thank you very much for having us. Like any other countries, Angola economy has suffered from the shock of COVID pandemic. But not only because we were recovering from the shock on oil prices. All those elements brought to us a lot of challenges that authorities had to tackle, implementing some strong measures on the public health, fiscal one, debt sustainability, and also monetary policy measures. On the monetary policy measures, we have one specific one, which is very important for us to be to make guarantee to international investors, which is since 2018, a new foreign currency law or approach was implemented by the central bank, the one who allowed more diversified players to bring and to buy and sell foreign currency in our market. Also, one of the main important measures that was taken by the central bank was implementing a new platform to trade the currency in the country, which is the Bloomberg FX Go, and there are a lot of players playing in this selling, buying, selling in this platform, such as oil companies, also diamond companies, and even the Treasury make a deal in this platform. So we believe that this brings a lot of transparency on the price, everything what could be sold, and also bring some more confidence to the investors. On the other hand, having said that, this is there is something that is also important, is that the opening of an international account by the central bank for those who want to make investment through the exchange, I would say the stock market, brings more confidence to those investors that could come in and step out whenever they want.
Talking about Angola's privatization program, Proviv, why is this an exciting opportunity for international investors? And what would your message to the global investment community be?
The privatization program is one of the main leads that the government is taking for doing the diversification of our economy. We have companies from different sectors that are being privatized. Telecommunication, all sector, tourism, financial sector, and also agriculture. We are using also this privatization program as a tool to develop our domestic capital market, because we believe that the way the things are, the deals are done in the capital market are more transparent and bring more confidence. And the other things that we believe that could bring other investors, foreign investors to our market is that regarding now our currency, or what is the exchange rate on our currency, we believe that could be the good moment for those investors to think about coming to our market, because they will be getting the benefits of the exchange. So exchange rate. So that's why we believe that could be a good moment to come to our market and to look at the privatization program as well.
Thank you very much for joining me today, and thank you everybody for watching.
What a joy it is to be at the Bloomberg Invest Summit. Myself, Caroline Hyde of Bloomberg Television, joined by a man who really needs no introduction. You know him, John Rodgers, of course. A man who is a legendary investor, but notably a value investor, having loved growth stocks for only a couple of years. I mean, when he was busy on the basketballs, the courts of Princeton, and going across the campus to go and put on stock trades, he moved from growth into value very swiftly and has now, well, been managing up to $16 billion in that global asset management firm that is Ariel Investments, which he set up at the age of 24. Extraordinary, John. It is wonderful to be joined by you now on what is almost the 35th anniversary of your main fund, flagship fund, Ariel Investment Fund. And as one of the only sort of length of tenure out there for mid-cap value funds, at this juncture, how do you feel? How do you feel about the market, about valuations, about volatility?
I think the market is in sort of two different places. I think that the S&P 500 that is so dominated by large growth stocks is very, very expensive on a historic basis. So I'm not surprised to see this most recent retreat and correction that we've been going through. But the small and mid-cap value sector is still, I think, significantly undervalued. There's a lot of bargains out there, a lot of orphans that have been kind of left for dead that no one cares about. So it really is a tale of two markets. The large growth stocks are expensive, but the small, mid-sized, undervalued securities are real opportunities there.
Just give us, first and foremost, your distinction of what a value stock is right now. John, can you hear me? Oh, we're just having a pause, a slight technical issue. We'll wait for him to come back online. As a man who can help describe exactly what a value stock really means, there's much debate, and of course, many know that to a certain extent, the S&P 500 at the moment, we're seeing growth and value stocks basically at parity. We're seeing value stocks up about 15, 16%, growth stocks up to a similar degree. And remember, of course, it was value stocks that were actually outperforming at the start of the year. I think we've got him back online, John, and great to be with you. I just wanted to know what you thought a value stock was at this moment. Define.
Well, what we always look to is to, we've been very, very influenced by the world's greatest investor, Warren Buffett. We're always looking for the stocks that are statistically cheap, selling at low price to EBITDA multiples, low price earnings multiples on a historic basis. And ultimately, at the end of the day, we want to find companies that are at least selling at a 40% discount to their private market value.
Okay, so when you then are focusing in on small and mid cap, is size a distinguishing factor when it comes to value from your perspective, or is just feel that that's the area of opportunity where people are overlooking because you have to get more nitty gritty?
Well, I think that there is more opportunity in the smaller stocks for sure. When I started in this career 38 years ago, there were so many analysts following the small stocks, and people talked about the blue chip stocks kind of being blue chips because they weren't going to be able to grow as fast. They were going to have, just lack of opportunity because they're more efficiently priced. But today, so many people just fallen in love with growth stocks, fallen in love with chasing the hot stocks of the day, the meme stocks, the fast-growing companies. They're just leaving these small, undervalued securities just totally neglected. I call them orphans. And so there's just this real opportunity that I've really never seen before, where you've seen such a dichotomy between different sectors of the marketplace. It's so dramatic. Now, I do feel that the higher interest rates that are starting to come in are really going to impact large cap growth stocks significantly, because they've been able to make a case that they're undervalued if interest rates stay incredibly low.
Is it interest rates that are the risk here, or is it inflation? We're seeing notes put out by Citigroup's chief global equity strategist today saying, look, get into financials. That's where you can protect yourself. We're not talking about absolute growth, but we're talking about a level of protection against inflation. Is that an area that you're worried about, or is it interest rates that really you need to be honing in on?
I think interest rates are the thing you have to be honing in on, but of course they're tied directly to inflation. If we continue to have this really steady increase in inflation, you're going to see a steady increase in interest rates. And then when you do the discounted cash flow analysis on future earnings, those companies that are dependent on earnings coming 5, 10 years into the future, they're going to find their stock prices squeezed because of these higher interest rates. But we have tried to concentrate more in areas that we think will benefit from inflation. And whether it's real estate related companies or financial services companies, you suggest, we think there are some real bargains there that will benefit from higher rates. Probably our favorite is in the banking industry is Northern Trust. It's this iconic brand here in Chicago, great management team. And as interest rates go higher, they will be able to really be a prime beneficiary of that movement.
I want to go back to what you were just saying, and you saying about Chicago, and I think back to you growing up and a man who was ahead of, you at a very young age were into stock picking. Your father had helped bring that to bear, gifting at certain birthdays and Christmas. But you fell in love with growth stocks to begin with, and you say now people are falling in love with them too much. Now, is there an element that's the gateway to falling in love with the stock market in general? Should people be excited about the bright new thing initially, and then as you become more experienced and understand that actually you need to be a little bit contrarian to win out in this market, therefore you then start to look at other opportunities?
It's interesting question. I think for me, fortunately, when I was at Princeton, Burt Malkiel had just written A Random Walk Down Wall Street. And he did a great job in that book, not only talking about efficient markets and how hard it is to outperform, but he shows you some of the great bubbles that occurred and the dangers in falling in love with the hottest new theme of the moment. And, whether it's a tulip bulb fantasy or what happened in the Roaring '20s, et cetera, et cetera. So I think one of the things I think is unfortunate is that if you don't learn early enough to maybe get away from chasing the hot new thing, when you get burned, you will be reluctant to get back into the markets. So that's what I worry about. So many people who got swept up in the internet bubble, basically swore off investing in stocks for a long, long time. And so I hate to see young investors, new investors getting into these meme stocks, chasing quick profits on Robinhood. I worry that they might scar them and discourage them from participating in the market for the long run.
And particularly when I know you're a man who has so focused on diversity from the very off. That's how you met your partner in crime. And of course, the person that's helped build Ariel Investments was through trying to bring more diverse people of color, diverse backgrounds into the University of Princeton. And it's something you followed throughout your career. Are you hopeful by new opportunities to invest, whether it be Robinhood, whether it be sort of the fact that we have to pay no fees to trade stocks, that we are able to build wealth among a greater proportion of people? Are you excited that people are getting into the market, but hopefully we need more, is it financial literacy to ensure that they're not getting in and getting burned?
Yeah, I think financial literacy is key. It is really, really important. As you know, 25 years ago or so, former Secretary of Education Arne Duncan and his sister and I created a small public school called the Ariel Community Academy. And the idea was that every first grade class would get a $20,000 class gift, watch us manage it through our funds for the first 6 years, along with John Naveen. And then in 6th, 7th, and 8th grade, the kids would start to pick real stocks with real money and benefit from their own stock selection and learn about financial services careers by visiting with our analysts and talking to our analysts about how to do research on individual companies. So when I had a chance to chair council for President Obama on financial literacy, the recommendation we gave the president was to encourage all financial services companies to partner with urban public schools and get young people, women, people of color exposed to the markets at an early age and get them comfortable. So when they get out of college, they've had a chance to have experienced real life investing. And so we think that's just so important. We've got to get our public schools focused on financial education, learning about the stock market, the magic of compound interest. And that was one of the beauties of our program is the kids got to see money grow over 8 years and see that real benefit of how time helps you as all inevitable ups and downs occur, but the markets trend higher over time.
And to that, and therefore you're looking at financial literacy, you're understanding a way of trying to build that momentum and hopefully that brought to bear actually the partnership that we see. But are you worried about us being in a bubble right here, right now, which might burn others? You talk about sort of the worries of after the internet bubble. Are we in a bubble now, John?
I think parts of the marketplace are in a bubble. I do, and I've said, it's not only the meme stocks and the hot growth stocks that have done well, but of course it's the cryptocurrencies. Everywhere I go, whether it's I'm in an Uber car or whether I'm in a Lyft or something, even my favorite pizza place, the delivery guy wants to talk about cryptocurrencies. And that's a sign when everybody who's not an expert in the field is like, I want to get in there. And all my friends have told me how I can get rich quick in this. That is a real sign that you're at the top of a bubble. And so there's certain sectors that are very, very worrisome.
I mean, at this exact moment, just as you were putting those thoughts to bear, an audience question came in saying, does Ariel itself have exposure to cryptocurrencies? I mean, Ben Miller, another value investor, he's saying he loves Bitcoin. Are you exposed, or is this just not a game for you?
It's not a game for us at all. It's sort of interesting. Bill Miller is a great friend, and we have a lot of respect for each other. We share stock ideas and talk to each other regularly. But this is just an area where we have a agree to disagree, and I'm very cautious. I know Charlie Munger, of course, has been very vocal about this, and people like Jamie Dimon and others have been pretty cautious. So I think it's a time to be cautious.
Why? What is it that puts you off?
Well, as Warren often says, commodities, like if you buy gold, it doesn't produce anything. He jokes around, you can go and shine it and you can look at it, you can study it, but it's not like a farm that produces corn or whatever it happens to be, or some other manufacturing plant that produces all kinds of goods and services that can benefit mankind. So that's the same thing, I think, that when we think about something like cryptocurrencies, there's no real economic benefit that comes from it that we can see. It's just another commodity. It's such a volatile commodity that we can't quite figure out how you would use it to buy and sell things when you could have this currency moving in such dramatic ways. And I think our financial systems worked very well for, over 100 years. I don't think it's time for us to try to have a brand new one.
Okay, so it's not a question of regulation. I'm not going to stick with crypto too much, but there's audience questions coming in thick and fast on it. But would DeFi be more of interest because they are protocols that are growing something different, or is it an element of regulation that would ever take you there, or really it's just the element that this isn't your contrarian idea, this isn't value investing?
Well, certainly not a contrarian idea, that's for sure. So it would be very hard for us to get interested as an investor. I watched Ken Griffin, who's one of our outstanding investors here in Illinois and nationally, founder of Citadel, and he was talking about this for an economic club conference this week, and just saying the regulation would help because then they would be able to trade it and be able to do that effectively. So I think regulation is important. You just can't be the wild, wild west out there with currencies, and you've seen China has been very, very negative on it. So I know Gary Gensler is focused on this. He's an outstanding SEC chairman, so I'm confident he will come up with a program that will help, and maybe that will lessen the volatility, and maybe it won't be as easy to trade, but it'll be something that you have more certainty around it once you have the regulations in place.
And as our own dear Eric Schatzker, who's in conversation with Ken Griffin at the Chicago economic discussion there, and I'm interested in, it was sort of Eric was discussing yesterday what was coming out of the Bloomberg Invest Global Summit was this view that actually now is the right time to sell. We were hearing it from authorities over at Blackstone, voices that came from Brookfield Asset Management. Is now the right time to also take profit, to liquidate amid a liquid market, or is now the time really to buy and keep on buying any dips that we see?
I think you can buy the dips in the parts of the marketplace where there are bargains, and I do feel, as we've talked about our small and mid-sized favorite companies like Madison Square Garden Entertainment is one of our favorites, that they own the Madison Square Garden in part of New York City. We love Lazard. Ken Griffin is a terrific CEO there, and all the deals happening around the world. Lazard is in the midst of many of them, and being a global franchise in investment banking and also in the money management international sector. So that's another financial services company we believe in. KKR has been a holding for us for a long, long time. And so we think private equity is going to continue to grow and thrive. And Henry Kravitz is still in the saddle, helping drive that company. So there are opportunities. And one other area beside, the garden itself, the sports-related teams. We think a lot of the sports teams are cheap. When you start to think about how you can use those assets, the personalities of the players, the brands of the teams globally. So Manchester United has been very weak lately. We think there's bargains there. It's international soccer brand and really a true global enterprise. Madison Square Garden Sports is something that we think is great. That they own the Knicks and the Rangers, and and sports teams are going to be able to again be more and more global, be able to use their brands and their extraordinary athletes to generate more and more revenue, and people want to watch these games throughout the world. So there's real opportunity, and of course, with all the money coming from the gambling side, with FanDuel, et cetera, that makes these sports franchises worth much, much more, and they seem to be very cheap here.
John, you were a pretty good athlete, pretty strong on the basketball court. I mean, were you interested in sports teams? I know that you have a lot of focus on female basketball playing in Chicago. Is it something that you want to grow as an asset class for you?
Well, it is, as Warren says, you always invest in your circle of competence. And I did get a chance to play for Hall of Fame coach Pete Carril at Princeton. He spent 29 years there and 15 years as an assistant coach of the Sacramento Kings. He was a genius. He's in the Hall of Fame, and it was great. When I got there, I wanted to be a basketball coach. But when I got there, he made it clear that my basketball knowledge was not what it needed to be. And I realized I wasn't as smart as he was, so I understood a career in basketball was not possible. He kept me around the whole 4 years because I played really hard, and I got to be captain. Got a chance to play for a while, but it was an extraordinary experience. So it gives me a sense that I do love basketball. I'm on the board of Nike, which I'm really proud of, and it's been great to get to be with Phil Knight, and the late John Thompson was on the board. And but finally, as you said, the women's team are fun. You know, being involved with the Chicago Sky has been a real blessing, and to support these dynamic women. And we're finally, I think, starting to build real momentum. The ratings are up 80% year over year in this playoffs this year. I think there's going to be a real opportunity when people see these women that is going to grow into an extraordinary success. So really excited about that, and really excited about our hometown Sky team, hopefully making it to the finals.
Yeah. Even though I'm not a Chicago fan, I will be for you, and particularly about those women. But John, so you didn't have, therefore, quote unquote, the vision on the basketball team to become a coach, but what do you think's made you distinct in terms of having the vision to become, you know, such a legendary, and I don't use that lightly, value investor, to be able to build up a 16 billion in terms of assets? Like, what was it? How have you been able to see things differently, to have the longer term vision as to what wins out? Because we're saying, almost 35 years in your fund, and you always beat the benchmark.
Yeah, well, not always beat the benchmark. We're proud of the 35 years ahead of the benchmark, and also the last 1 year, 10 year. It's been a really great period for us. But it's interesting to bring up that term vision. Coach Carlyle said that I was legally blind when it came to basketball, and that he couldn't teach vision. One thing he couldn't teach. So I think I've been blessed that I do think I've had a vision at Ariel to, one, identify great talented people, you know, early on, like a Melody Hobson, who I met when she was 17, and, you know, other talented people. The CFO at Northern Trust, Jason Tyler, I met when he was 17 and knew he was going to be a superstar. So I've had a vision around people. We have a great research group at Ariel. It's very strong, dynamic, a lot of University of Chicago Booth grads there that work with us. And then I've been able to have a little vision, I think, on which industries we're going to succeed and thrive looking out over the long run. As you know, we are long-term investors with the turtle logo, and being able to not get swept up in the emotions of the moment and the drama of the moment, but being able to see a little out beyond the horizon, and being able to buy in the midst of financial panics like 2008 and 2009, or be able to buy a year and a half ago at the height of the COVID crisis. Being able to see over that horizon, having that vision, is something that has helped our performance over the long run. A lot of our performances come in those periods when there's been dynamic change and dynamic volatility.
And you talked about that volatility being almost upon us. We've got but 1 minute, but there was an interesting audience question that came in beforehand towards you. And it's David from Greensboro, who is saying, therefore, are you a bull or bear on the overall stock market out to like 2023? Do you think we're set for downward trajectory, or will we generally go higher?
Looking out toward 2023, I think it's going to be a really tough time for the S&P 500 and the NASDAQ to be successful, but it's going to be a real wonderful time for small and mid-sized undervalued securities, sticking to those industries that have underperformed over the last 10 years or so. You know, it's been brutal, but it's only fair that turnaround is fair play, and if you're a contrarian, these ideas will do well over the next 3 to 4 years.
And last one for you, John. You just talked about listening to Ken Griffin earlier about Chicago. You still think it's a good place to build a business?
Oh, I do. We love our city, and Melody and I, we love Chicago. We're committed to Chicago. It's the greatest city in the world, and the way the business community works together with the community, and it's something special here.
Well, we thank you so much for your time from Chicago. Pretty grey over there, pretty grey over here in New York, but it was a really blue and interesting conversation that we just had with you. Blue sky thinking, as always. Contrarian take from John Rodgers. We thank you of Ariel Investments. Stay well.
Thank you.
I'm Scylla Brush, a reporter covering asset management on the investing team for Bloomberg in New York, and I'm pleased to be joined by Hanneke Smits, CEO of Bank of New York Mellon's investment management part of the firm. The firm manages $2.3 trillion in assets as of the middle of this year, and you have 30 years of investment experience across a variety of different parts of the industry. and different parts of Bank of New York Mellon. One theme that has come up repeatedly across our conference yesterday and today certainly is ESG and sustainable investing. A lot of discussion about the growth over the last 18 months. Where do you see this going from here in the next period? It's grown significantly, but where do you see it going to next? I think we have you back now.
Yes, you do have me back. So it's good. It's good to be here, still virtually. It would have been so much better in person, and we didn't have to deal with these little technical issues. Having said that, it's been a boom for climate change, right? Which I think has been one of the drivers behind the increased interest that we've seen both in the market as well as in BNY Mellon Investment Management in ESG. So where do we see it go from here? Because I don't think I need to be reciting the growth in the marketplace. And what I think we'd be seeing is that ESG becomes a much more standard part, if you will, of investing. It's an expectation that investors have that the ESG principles are embedded in the portfolios. And we're also going to see, as a result of this, increased regulatory oversight, right? And a requirement for all of us to report on a consistent basis, which I do think is going to be important for the ultimate end investor to have confidence in the products in itself.
Just in terms of that data and reporting question, in the last couple of months, we've seen repeated stories, allegations of greenwashing. Just this morning, and there's sort of more questions about DWS and scrutiny of its allegations of greenwashing at the firm. How much greenwashing is there in the industry, and what is your firm and you, what are you doing to sort of guard against this? What do you need to see to stop this from happening?
So I think if you just take a step back, anytime that there is something new, there's always a risk of greenwashing, almost irrespective of what we're considering. In this particular case, we very much believe that greenwashing can be addressed, as I was just alluding to, through more consistent ESG regulations, definitions, and approaches. And to that extent, in the EU, I think a significant step has already been taken forward with the introduction of the SFDR, Sustainable Finance Disclosure regulation. And we believe that's not only a significant step, but it's also really a positive step forward. What we would like to see as regulators around the world start to focus in on this, that there's a greater harmonization and coordination with respect to the approaches that various regulators are taking, so that we can all approach the reporting in a consistent manner. From our perspective, we obviously take the reporting very seriously. We have a long track record in reporting as well as in ESG. For some of our firms, it goes back over 40 decades, and it's something we continue to work on.
One jurisdiction that has, you mentioned Europe, but one jurisdiction that has not put any firm rules, though, is taking clear steps to scrutinize funds for potential greenwashing, is the United States. Europe has some rules that's several years ahead. How important is it that the U.S. comes on board? What do you want to see out of the SEC?
So it's similar to the EU. I think the SEC agenda in particular is clearly guided by the need for disclosure, ultimately to the benefit of the investors. And we expect to see more clarity on ESG risks, for example, in company filings. We would like to see, as I just mentioned, harmonization of ESG terminology used by issuers and investment advisors, and to the extent that the SEC has a role to play in that, we would welcome that.
Should the U.S. essentially copy and paste what Europe has?
Not necessarily copy and paste, but coordinate and collaborate.
And what does that mean, though, in terms of your business? As you know, there's a lack of standards in America. What does that mean for the development of funds and for the sort of engagement with investors? Is it a roadblock, or is it, how do you navigate this sort of interim period where there are, you know, less clear-cut rules in America?
So if you take a step back, there's a lot of data out there that measures the degree to which portfolios are beating benchmarks based on the ESG approach or the responsible investment approach that is being taken. The challenge that the industry has is that the data out there can be in conflict with one another, as a result of which many investment management firms, including some of our own subsidiaries, have taken also the step to develop their own rating system to compare that against the other data sets that are out there, which I think for now has been very, very useful for our clients. For example, Insight, our fixed income manager, has developed something that's called prime ratings, which is very helpful in providing signals to credit.
You mentioned sort of your own investment process and research. Another theme that's come up in several panels is kind of a look or a relook at active management at the moment, and maybe a need in the industry, or an opportunity rather, for more active management. Where do you see the sort of role of active management going now? Are we, especially in terms of ESG and sustainable funds, how much opportunity is there for, as you said, your own in-house ratings or maybe own in-house investment research? What's the opportunity for active management within the ESG industry?
So I actually think this provides a great opportunity for active management. You might expect me to say that, but I really think it does, because for active management, one key part of what we do is clearly we manage the assets that our investors entrust us with, but we need to do so in a responsible manner. We're allocators of capital, and we very much believe we need to engage with the issuers and the management teams of the companies that we own. And that is something that I think plays right into the hand of active management. You need to actively engage, you need to analyze the companies, you also need to include ESG in your analysis, because ESG can highlight both material risks as well as opportunities, and helps to inform the analysts how to exercise their votes and how to engage with management, which ultimately can have an impact on the financial performance of both the stock as well as the portfolio.
Are we now at a moment where
it's a pretty exciting time?
Do you mean that we're sort of at a moment where, you know, the concept of just sort of screening out investments, maybe just screening out a fossil fuel and an oil company, is that sort of the last generation of ESG? Are we sort of at a new kind of approach to this kind of investing, where it's, you know, either about engagement or, you know, voting on, voting at meetings, or are we beyond that sort of screening process?
So I think there's still a bit of a divide. We are about voting and engagement rather than screening out. We think it's actually very important to engage with companies with respect to how they allocate capital. And that includes engaging with companies that right now are in the oil and gas sector, and being able to cast a vote as to how they are going to allocate their capital towards a transition and to meet the goals of a net zero environment.
Are you worried that, you know, repeatedly there's this concern about companies that are, you know, maybe dirtier brown fossil fuel companies, that the cost for them to raise capital because of, you know, asset managers steering away from them, does that worry you at all? Like, will that make it sort of some of these, you know, oil majors uninvestable?
Look, that is just another piece of information that the analysts will have to take into consideration when they actually evaluate the stock, right? What is the cost of capital? What is that being put towards, and how is that being invested? And the answer will be different depending on the stock that is being analyzed and depending on the sector.
Just north of you later this year, COP26 will be coming around. What do you hope to see out of that for specifically the asset management industry? What more essentially do you need to know in order to, allocate more capital to sustainable funds, steer clear of maybe other kinds of assets? What do you hope is achieved out of COP26?
Look, I think it's an important moment in time for both governments as well as asset managers, private companies to come together to set some goals as to how we're all going to manage towards this transition. Each of us have a role to play in that, and it will be different depending on your starting point. But I do hope that we get clarity out of COP26, and I think asset management has an important role to play in that conversation.
Sort of away from sustainable funds and ESG, another topic that's sort of near and dear to many panels is crypto and sort of blockchain technology. What I think Bank of New York Mellon on the sort of custody side has looked at blockchain. Where do you see the role of either or both blockchain and crypto for Bank of New York Mellon? What do you hear from clients about or investors about their desires to have exposure to it? Do they tell you that they want more ability to invest in Bitcoin and the like?
So we haven't seen as much yet. We are obviously evaluating digital asset class solutions, and we're listening to our clients to determine their needs. We believe that at the highest level, digitization could represent the next frontier if you think about the democratization of investing, whereby you could use the blockchain technology to remove some of the friction, perhaps in less liquid asset classes. We do currently offer a blockchain innovation usage fund, which is an actively managed global equity strategy. But I would say on the whole, clients are exploring what is possible, but I wouldn't say that we've had a huge amount of demand for specific solutions at this point.
Do you see that in both institutional and retail?
Similarly, but most of our clients are institutional, so that is where our discussions have been largely focused. It is clearly an enormous important development, and one that we're watching very closely, and also working with our colleagues at the bank on, who, as you know, have launched the BNY Mellon Digital Assets Unit, which is a digital custody platform, which we announced earlier in the year, and is a hugely exciting and important development.
Just on this, do institutional traders want and clients want just the ability to invest in blockchain assets, or do they want the ability to hold? Do they want you to be able to hold Bitcoin and hold crypto?
I think for now, our discussion has focused on enabling a broader adoption and delivering an end-to-end solution for the client. So it's more on the custody and hold side. And then from there, we're working on additional solutions for our clients, including in investment management.
So it's something that clients might be able to invest in the future with you?
Correct.
I think that's about the end of our panel. Thank you so much for taking the time to be with us from London. I'll turn it over.
And welcome to this Letter One roundtable discussion on long-term investing in a short-term world. I'm Stephanie Flanders, head of Bloomberg Economics. We're here gathered together to talk about, as we recover from the pandemic, whether we can really make long-term investing part of this new landscape, part of building back better that we've talked about so much. We have a great panel of people to talk about that. But just before we get started, I wanted to introduce Mervyn Davies, Lord Davies of Abersoc, who's chairman of Letter One, which is sponsoring this session. Lord Davies is a former trade and investment minister who is now chairman of Letter One. Mervyn Davies.
Well, thank you, Stephanie. I think, one of the most interesting aspects of having worked in the private equity market, but also in the public arena, is that I think Letter One has the luxury of being private, is able to take a very long-term, 5, 7, 10-year view of businesses. And I think one of the challenges at the moment is that institutional shareholders, the owners of publicly listed companies, don't show a lot of interest in long-term thinking. And so I think the other factor at the moment is the number of listed companies across the world is shrinking. Hedge funds own a large proportion of the listed market. So even if you're a CEO or chairman, you don't meet the hedge funds and they're only owning the shares for a few hours. So I think that the hedge fund activity, the fact that there isn't a lot of institutional interest, coupled with the fact that the private markets are growing exponentially, means there's increasing pressure on the public company arena. And I think it's going to continue to grow, particularly with ESG, which is very important that companies embrace it. But I think the bureaucracy level in a lot of listed companies is stopping entrepreneurialism, and a lot of the flight of talent and capital is going into the private arena. So from where I'm sitting as the chairman of Letter One, we're taking a long-term view of business, and I think that is going to be critical given the pace of change with climate change, with technology, et cetera, et cetera. So a challenge for listed companies, in my view.
Well, that is, we do, and we hear that quite a lot from the private equity community, and we have members of that world represented on this panel, but also others, thinkers, and other business people. So let me quickly introduce them. Ironically, we have 6 people to talk in a very short time about the long-term investing, but I know that they're going to do a great job of it. Joanna Rocha-Scaff is head of European private equity at Neuberger Berman, and among other things, is on the firm's ESG advisory committee. Brian Dumaine is the founder and editor-in-chief of the media company High Water Press, and is also the author of a lot of books, and I will just name one of them, Go Long, Why Long-Term Thinking is Your Best Short-Term Strategy. Matthew Agarwala is an economist who leads the Bennett Institute for Public Policy's Wealth Economy project at the University of Cambridge, and he's also heavily involved in the new Productivity Institute. Dame Jainan Gadia is the founder and executive chair of Snoop, and made her name before that as the CEO of Virgin Money from 2007 to 2018. And she was also, until very recently, the UK government's Women in Finance champion. Rishma Sohoni, finally, is managing partner of Seed Camp, the European seed fund that she co-founded in 2007. And interestingly, it has since done exactly what I think it was planning to do, which is to back nearly 400 European entrepreneurial companies, including the extremely successful fintech companies Wise and Revolut. So welcome to all of you. There's so many issues around here. Maybe, I mean, Rishma, maybe I'll just ask you for your sort of reaction to what Mervyn was saying, and sort of his view of, what he said seemed to me you could have said a few years ago, but yet I thought we were in this world where we were all thinking differently about investment and the future of growth.
Yeah, no, I think I'll pick up on that. I think just to say, venture capital, I mean, we literally are in the business of taking the long-term view of technology that will be fundamental to how, we want to see the world in 10, 20, 50 years. So we start off with that. And a lot of the short-term pressures work in our favor in the sense whether, such negative things like obviously the pandemic and other elements to just changes in consumer tastes and behaviors and shocks work towards, where we think particularly ESG and other kind of fundamental changes need to be. So to pick up on what Marvin said, yes, we're seeing the same thing is, with that outlook, TransferWise was started kind of 2010. We're here 11 years later, this company going public. Our companies are going public, at plus 10 billion mark. I mean, that was unheard of, but it is because they're being very thoughtful and choosy about who to take around their table on that cap table from that first check where we write 100K checks, 500K checks, all the way to someone putting in 100 million and a couple 100 million around. And so, it is those, and a lot of those stories are founders who are still CEOs 7 years later, 11 years later. And so, they are staying private longer. There is capital there. And I think it's a lot about, the game you're playing is if you're out here to play a 10, 20-year game, you need the right allies around that table. And that's where the incredible returns are versus, the short-term rushes of the hedge funds, right? And so yeah, absolutely, we are seeing our companies stay private longer. And I think us as that first 100K check-in, we're able to get liquidity at the timelines we need, which is more around that 7 to 10 year time frame, which I'm sure for those into day trading and short-term trading, that's kind of crazy. But that's the view we have. And so it's taking that decade for companies to get into the public markets.
And Joanna Rocha-Scaf, is that the world that you see, or do you see? Do you also have some of the same concerns that Lord Davies was talking about?
Absolutely share the concerns that Lord Davies was highlighting. And actually, I have the statistics for the U.S. market. So to put it into perspective, in 2000, there were over 6,000 U.S. listed companies. There are under 4,000 today. I'm looking at the number of private equity owned companies, and it was just somewhere around 1,500 back then. It's near 9,000 now. So exponential growth, as was mentioned in the private equity industry. Now, there's lots of criticisms on private markets. At the heart of it, and just to make sure everybody's, the audience here is fully clear, private equity is not well understood sometimes by many people outside the financial world, but at its root, it's fairly simple. Investment managers set up long-dated fund structures with somewhere between 15 to 10 years to invest in companies that are private. So they're private and stay private, or they are public and then are taken private. And there's lots of criticisms about the asset class. The most common ones are obviously fees and illiquidity, obviously. But I would say that one that it would not be fair to make is that private equity is short-term oriented, because it's not. Investments in our world, they are typically underwritten to a hold period of 4 to 7 years. That's where the mode is going to be. You may come out shorter or longer, but generally underwritten to a hold of 4 to 7 years. And in our industry, you're also seeing the advent of what I would call long-term private equity funds or core funds, and they actually have a lifespan of over 10 years. So you're underwriting investments with a 10 to 12-year hold typically. So this cannot be made and dealt with short-term pressures and goals in mind. If one doesn't make technology investments, your company's technology might become obsolete. If you don't invest in the product, if you don't invest in the brand, if you don't invest in customer service, your customers might defect, churn out, and move to the competition. You have to invest in factory, logistics, and I could keep going to deliver these things efficiently over the long term. So ultimately, again, there are many criticisms about private equity, but certainly the short-term orientation would not be the case, which is very different from the comments that were being made around the public equities market. The public equities market is very much I mean, it's very liquid, so people can trade in and out. And it has that more trading mentality where you might be looking to do short-term profits. In our world, that's not possible. Your profits are going to come and materialize, hopefully, after 5, 6, 7, or in some cases after 10 years. So if you do not build better businesses, and if you don't future-proof your businesses, by the time you're actually going to crystallize that value won't be there. That's a key point.
Just to pick up, I think it's a really interesting point there. I think public equities has become, to what you just said, a realm of the traders market, and the private markets are the investors market. And it shouldn't be, as all of us who have pension money and that goes into public equities shouldn't be the case. But that is what it appears, and it's really frustrating, disheartening.
Brian, I was going to ask you, I mean, from your perspective, and you're writing about this all the time, and you're not just writing for the benefit or thinking in terms of private markets, is it possible to be following the kind of long-termist prescription and be a public company in this day and age?
Yeah, absolutely. One of the things that's happening in the public markets is that a greater percentage of investment is coming from the big index funds. I think in the States it's 20 to 30% from the Vanguards, from the BlackRocks of the world. And by definition, they're long-term investors, right? They have to hold the stock no matter what, for a long time, forever, as long as they exist. So they're long-term investors. And companies like BlackRock and Vanguard are becoming more active in the governance of these companies. They engage, I think, on average, Vanguard engages almost with 1,000 companies every year in terms of, are you on a long-term track for growth? You know, do you have the values that we're looking for in terms of sustainable growth? And it is possible as a public company to aim for long-term sustainable growth and thrive in the stock market. Of course, there's tremendous short-term pressure from the hedge funds who are not long-term investors. They're just in and out of a stock. But the companies that have tried to invest for the long term and manage for the long term, often do quite well. I mean, I wrote a book on Amazon called Basenomics. I spent 2 years studying the company and spending time with their executives. And they're the ultimate long-term public company. And everything they do is for the long term. Jeff Bezos always said, most companies are focused on the next few quarters or at best a year or two out. He looks 5 to 7 years out when he's managing Amazon. And that keeps him a step ahead of where the competition is. And, the results are obvious. I mean, it's one of the most valuable corporations in the world. And for 10 years of Amazon's 25-year history, the company wasn't making any money. I mean, it was investing everything it made into R&D, into its customer service functions, into its technology platform. And somehow Jeff Bezos persuaded investors to be patient, right? Even though we're not making any money, he focused on cash flow. And he said, if you let me invest this cash flow in growth, I will give you the results in the long term that you're looking for. And it worked.
Jane Gadia.
Thank you, Stephanie. Well, that was really interesting, Brian. I mean, from my point of view, I set up Virgin Money as a private company. We listed it, sold it, and now I'm running a small company again that's private. And I was thinking as you were talking that it seems to me that the thing that is most important is growth and innovation at the moment. We seem to be so much at a tipping point around the way in which consumers want to be served and the way in which companies are going to achieve what consumers want. But I'm not so sure these days that the short-term profit cycle that I was used to in the old legacy bank world is quite so relevant. If I go out now and talk about being a disruptor in my tiny little business of Snoop, I get far more interest than I used to when I was making, tens or hundreds of millions of pounds profit in Virgin Money. I was actually talking to a banker this morning about Virgin Money, funnily enough. It's 3 years since we made that sale. And he said, you know what, that's the size of business that the banks aren't so interested in anymore. We're interested in the really big ones and how they're going to survive. And we're interested in the disruptors and the difference that they're going to make. And so, from my perspective, I do think that that investment mentality seems to me to have been shifted quite significantly. And your Jeff Bezos comment makes me think about that, looking to the long term, serving the customer, being innovative and delivering along the way. I was also talking to a different company a couple of days ago. I'm on their Remco, actually. And we're having exactly this question at remuneration level, to what extent do you reward short-term performance compared to long-term performance? And concluded that actually, I can't remember the proper quote now, but every journey it has to start with the first step, doesn't it? You have to get your short-term performance right in order to achieve your long-term goals. And I'm not sure it's an either or. I don't think, Stephanie, that we should be thinking, is it short-term or long-term? Let's put together a plan that's going to be exciting and innovative for the long term with the consumer in mind and show how what we do today is going to get us to that place tomorrow. And I think actually that's, in my experience so far, what seems to give investors confidence at the moment.
That is interesting what you say about the sort of joining up the short term to the long term. I'm sort of struck by, Mariana Mazzucato has obviously made much of this sort of mission-led approach or the sort of moonshot approach to getting things done. And it's interesting because it is about setting a long-term goal, but it's also about being completely short-term and aggressive about the pieces that go into it and what you're going to do right now to achieve that goal. So it is I think you're right that the two need to go together. Matthew Agarwala, you're at the Productivity Institute, I know, is quite focused on at least a piece of what Jainan was talking about, innovation, clearly, but also what these kind of models for growth could be at a firm level. So, what's your take on this?
Well, I hate to be the bearer of bad news, but I think if
economists always have to be, it's my you're always like
your job.
You're the cold water correspondent. I'm sorry, but
so I suppose, as you say, maybe I should have picked a different field. But not just am I an economist, but I also have a lot of research on environment and climate. And so if we're thinking about the pressures that we're facing now, following the pandemic, following a really sort of long-term evaporation of productivity growth in developed economies right across the world. Since the financial crisis in the UK, it's been 0.03%. I mean, a tiny productivity growth. How do we start to invest now to get beyond this? Not only coming back from COVID, not only addressing the long-term productivity slowdown that we faced, but responding to the pressures we're going to face from climate change and further environmental degradation. And the way that we do this is going to have to take a long-term investment perspective. But it's not just long-term, it's also broad-based. So when I use the term capital as an economist, and I'm explaining economic strategies and how we might spur growth for the long term, I'm not just talking about financial markets capital. I'm talking about real, tangible, physical assets, infrastructure, plant and equipment, factories and buildings, and the capacity that all of our physical supplies have to produce and support output long into the future. But it's also natural capital, a stable climate system, healthy, clean air that we can breathe without getting sick and then having to take time off work as a result and reducing cognitive capacity and labor productivity. It's our social capital, the amount of trust that we have in each other, in businesses, and in governments. If we cannot trust a government that's making a net zero pledge, that we're going to decarbonize, we're going to take internal combustion engines off the roads, then we can't plan to invest for the transition. So it's a broad set of capital assets that we need. It's human capital, health and skills, it's physical infrastructure, it's natural capital, and businesses have a huge role to play here. There is no path whatsoever from any climate projection that delivers net zero without mobilizing private finance. The sums of investment that are needed are far higher than the public sector can handle. So the role of the public sector isn't reduced by this fact, In fact, maybe even it's elevated. The role of the public sector is to crowd in private finance from every angle, from private equity, from publicly held companies, from long-term institutional investors, but it's to crowd in private finance in pursuit of net zero, in pursuit of the infrastructure changes, in pursuit of the changes in skills of the labor force that are going to be required. This is the only real way that we're going to be able to grow out of this pandemic whilst meeting net zero targets for the long term.
Rishma, and then I know Mervyn wants to get in as well, but Rishma.
Yeah, absolutely. And I'll say kind of again, shocks are amazing to do exactly that. I think, as you said, Matthew, consumers are ready. They're thinking generations, right? They're thinking, what am I leaving for my children and my grandchildren? And these are people in their 20s and 30s thinking about that. So, meeting that, what we saw in technology where we are investing in, we have a company called Garden that is in the space around nutrition and trying to help towards sort of hunger problems, nutrition problems globally. It was incredible to watch the pace of innovation, true technology innovation with vaccines and multiple approaches around different types of vaccines. And you can, almost have, the candy choice of what kind of vaccines you want, and the collaboration and the speed. And to what Matthew talked about is the real hard production infrastructure matching, software productivity, what computational power can do, what AI can do, what automation can do, coming together. And I see it. I see the benefits of, what happened with vaccines in the pandemic and the whole supply chain around that into then hard tech investing, and how many funds to say, to your point of crowding in investment, how many new funds are getting overfunded around ESG and actually making those investments where we used to think, should we really be doing this? We are, in our deployment cycle, kind of 3-4 year fund. This is a potentially 5-7 year investment, even for us, just to even get to the next round. And those are happening faster. And, I credit the global kind of collaboration around vaccines. And it's been an eye opener for the tech investment industry.
Mervyn.
Yeah, I was just going to build on that, Rishma. I think the nature of a conversation that's going on, doesn't matter whether you're public or private, in the business is changing. People are going to live longer. So why would they go to university at 18? I think the whole model for workplace engagement is going to change. You've then got the pressure of climate change, which I think, Matthew is right. I think it's good. We're not going to believe what's going to happen in that arena. Plus, the war for talent and technological disruption means you've got to move much faster as a management team. And as a leader, you've got to have individuals that have the ability to move with great agility. So I think that, the nature of the engagement, just to take issue with what Brian said, Amazon, look, extraordinary story, but they are an exception. If you go and talk to shareholders at the moment of publicly listed, whether they be Vanguard or whoever, and say, I want to take a 10-year view of my business because of all the issues I've discussed, we've really got to, take a different tack. I think you probably would be replaced. So I think all I would say is the nature of business, it's getting faster, it's getting harder. And I think culture, values, and speed, agility, these are all the issues that the business is going to have to address. It is easier at the moment to do that in the private arena.
Joanna.
I wanted to add a few points to this discussion. Obviously, we've seen a disruption caused by the pandemic, but frankly, we've seen a lot more other than the pandemic in the last 20 or so months. I mean, we've seen racial incidents and protests. We have seen extreme climate events. And I do believe that as a result of all that is going on, there's a materially enhanced focus on sustainability by society at large. This is governments, regulators, companies, and frankly, consumers. So this is a mega trend, and I'd say like the good news, I guess, I'll bear the good news here, is that I think private equity is definitely coming to the rescue here. This has risen to the top of the agenda. I remember like a few years ago, going back to the US, meeting with US private equity firms and asked about their ESG integration, they would look at us and say, can you repeat that? They wouldn't even know what that meant. Europe has consistently been at the forefront of environmental, social, and governance integration in investing and continues to be, but it's actually going mainstream. And it's not just impact funds that are being raised. Most flagship funds in private markets of larger managers are truly incorporating ESG integration in the way they invest and in the way they own businesses. And more and more GPs, and I have statistics I can share, and we track it, as was mentioned. I'm even on the ESG advisory committee of the firm. We track it very closely. But there's a recognition now that economic and sustainability objectives are not incompatible. In fact, they are actually increasingly correlated.
Yeah.
And there are enormous amount of studies that prove this positive connection between ESG integration and financial performance. And more important, I do believe that companies that have sustainability at their heart are actually getting a valuation premium in the market these days.
But it's not always, I mean, it's interesting. I mean, Jane Ann, it's not about ESG anymore, is it? I mean, ESG has, and of course, we do have some major companies now that are abolishing their ESG committees because it's supposed to be everything that they do.
Everything that they do, it's sustainability at the heart of the business, at the heart of the company.
Jane Ann.
Thank you, Stephanie. If I may just jump in, I completely agree with you, Joanna. If I were to look back at, you mentioned the Women in Finance report, Stephanie, that I was responsible for. I mean, the driver for that report was all about productivity. How can we make sure that we extend the workforce? But of course, it needed to start somewhere, if you see what I mean. And what happened was that we set targets for individual businesses to ensure that gender equality was something that was at the forefront of their mind, and suggested that those targets, whilst they were being set within the business, were made public so that senior management were held accountable, not least by the media for this. And I think, I wouldn't say that we've changed everything hugely, but I think we've made more change than we would have done without it. And I think, these sort of targets that we're talking about now also need to be clear and transparent, and management need to be held accountable for delivering them, I think. And actually, just pondering on it, I think that does link the long term and the short term, because we can start to set those targets today and hold people for delivering, the right sort of sustainability approach today. And if we don't do it, we're certainly not going to achieve it tomorrow.
Matthew. Oh, you're on mute, Matthew.
Sorry. I just want to pick up on a couple of points that have just been made. I'm skeptical of ESG. I have optimism around certain elements of it, but the scientific underpinnings for much of the environmental side are lacking. And there's a huge amount of research to be done here still to determine whether or not these ESG metrics are actually answering any interesting questions for us. On the other hand, if businesses use this as a way to start talking about their environmental and social and governance effects at the boardroom level, then more power to it. If it's actually forcing those discussions to take place, it can only go in the right direction. One of the challenges, though, is that we don't have the scientific underpinnings in order to validate all of these metrics. And so this is one of the things that we've been doing in the Wealth Economy Project, looking not at this ESG stuff, which there's very little correlation between the different flavors of ESG. And there's over 120 different providers of ESG metrics, and it creates a lot of noise. What we've done instead in research actually supported by Letter One is to demonstrate that core ratings products, the sovereign credit rating, actually will respond to the threats of climate change. And we can predict how these might play out into the future under different climate scenarios. To determine which countries' credit ratings are going to face a downgrade, and what is the knock-through on that to the impact not just on the sovereign credit rating, but on the cost of public borrowing. And then the next line in the dominoes is how does the increase in the cost of public borrowing affect the cost of private borrowing? And so we can start to calculate these things. But ESG as a blanket might not be the savior everyone's hoping it to be.
No, but Matthew, sorry, it does what it does. It gives you a framework. We're on a journey for more responsible capitalism, if you want a better expression. So what it's doing is giving a framework for discussion at the board, even if you're private, if you led one at the board meeting last week. It gives you a framework for discussion. I do think that if you're not on the train of ESG, either the consumers won't buy your products or your staff won't stay with you as a company, and you'll die. So I just think it's a great framework, and we're learning as we go along. And I do think it results in a better form of capitalism.
I think the risk is obviously that when you talk about the train, I mean, you need to be on the bandwagon, but whether you're actually doing anything substantive is sometimes the question. In fact, Bloomberg Intelligence has been doing some great work just looking at the underlying holdings of a lot of ESG indices and funds, and there's some pretty eye-opening results where people are charging quite high premium for funds which actually have, if anything, less environmental value than the S&P 500. So I think at the very least you have to do that kind of due diligence.
I think one of the things that's... Oh, go ahead, Jane.
I was just going to say the fact that Bloomberg are actually getting under the skin of that will make businesses think twice before doing it again.
I should hope so.
Which I hope.
Well, of course, our own gender diversity index does seem to be very robust, and companies that have got the diversity.
I think one of the reasons that it's so hard to execute on ESG is to Mervin's point about, CEOs still have to get short-term results because of the way our metrics are all set up. I mean, one proposal I came across, which was, no one's that I know of has done it yet, but why not make a chief executive's stock options, or the bulk of them, vest 5 years after he's left the company, right? So he's motivated to invest for the long term. He can then invest in these different ESG initiatives, or he can create the right metrics for them and not have to be under as much pressure from Wall Street. Now, that said, we've talked about you have to have both short-term and long-term. I mean, Jack Welch said, if you don't have a short-term, you don't have a long-term. But some of the best CEOs out there look at it as an S-curve, right? You have these periods of intense investment for the long term, whether it's R&D or new initiatives, and then the curve comes down and you manage somewhat for the short term. I mean, make sure that your initiatives are working, that you've got the right people on board, you've got the right capital deployed. And once that has taken hold, you go up the S curve again, and then you do another burst of investment for the long term. And I know Nadella at Microsoft does that. Bezos certainly did it at Amazon. And some of the best leaders have figured this out. I mean, it's not all long-term or all short-term. It's an S curve.
Matthew, I know you're dying to get back.
Yeah, there was just one last point I wanted to make on ESG. I mean, I'm professionally critical, but as Mervin pointed out, look, if it gets boardrooms actually discussing these issues for real, rather than just as some sort of CSR marketing spiel on the side, if it gets boardrooms talking about it and provides a framework for organizing their thinking and their investments for the long term, then that's close enough to job done. Don't let ESG metrics then dictate the direction of the investments. Invest for sustainability, and the ESG should come.
Can I add a point on this? You are right, Matthew. It is extremely difficult to track ESG, and honestly, what we mean about E, S, and G varies a lot depending on the underlying company or business model. I mean, if you take an industrial company, the E will be materially more significant. If you take a software business, social aspects, data security are materially more prevalent. But again, I'm not a macroeconomist. I'm an investor. I'm very much focused on the micro. And what I'm trying to tell here is that more and more private equity firms in private markets have realized that, hey, it's actually a great thing to integrate these aspects more into our model because it's actually sensible from an economic point of view. Let me give you two examples. If you can improve resource efficiency of energy, water, and other resources consumption, if you can reduce waste, if you can reutilize it, it may be extremely accretive to profit margins, but it also might reduce the tail risks and the costs of regulatory compliance down the road, and also will meet what your stakeholders and your consumers more broadly expect from you. One more, conscientious and responsible employee policies. Again, may lead to greater employee retention and engagement. In the long run, it actually might impact your company's brand value, its culture, and success. So my point is that there's ways to implement this integration at the micro level that produces outstanding results, both from an ESG standpoint and from an economic standpoint.
And to add, I mean, we're at that bottom level up, right? And because we start with these hundreds of Ks and companies that are 2 people, we're at a point to influence heavily. And I'll say, as fund managers, our job ultimately is, returns and IRRs, but the sort of push has come down and we're pushing it back up into our companies to say, every board meeting kind of goes with, as you said, for 90% of our companies are software. So it's a lot more about social inclusion, diversity. Science proves that diversity is good for you as a economically as a business. Then starting off with how many women are on your team, how many, other social categories of folks on the team. And these discussions were not happening, and they're uncomfortable. They're uncomfortable the first time. They're really uncomfortable the 5th time when you've done nothing about it. But what we do see is, offline on other channels, founders writing to us saying, that got me really thinking. And I'm now looking at other channels to recruit from. I'm putting in the extra energy that I just wouldn't have before. And if it starts with, companies like Hopin had 1 person in our office, it's now a few thousand. That matters when it starts at the 2 people, because Revolutes and TransferWise, these become ultimately 10,000 person companies where they start off as 2-3 people. And so it's happening, and it's great to see the push on us coming from our LPs, and and we're pulling up again into our companies. So it's all in a really good direction.
Well, on the push and pull, I mean, as an economist, I think of it also in terms of incentives, right? And so clearly there is something that's changed in the incentives where people are at least feeling that they have to focus on these things in some way or another. But Matthew, you talked about needing to kind of hold governments to account for their zero carbon promises, and what are they doing to get from here to there? How do governments kind of set the table for to incentivize businesses who maybe don't get the kind of pressure that Reshma is seeing?
Sure. Well, I mean, there are loads of policy levers that governments can pull, and some they can push to try and align the incentives. So the most successful ones that we've seen with respect to climate have been the heavy subsidies that were given to solar and wind energy generation about 15 to 20 years ago. If you were to look at an economic forecast 15 years ago, even 10 years ago, of the cost of renewable energy generation, you would never have guessed that it would have fallen by 85% over the decade, which is precisely what it has done. You would never have expected batteries storage, the cost of batteries technology, to do the same thing, but they have, and they couldn't do it alone. This isn't just a public investment campaign. It was public investment that crowded in private investment, that enabled businesses to figure out the efficiency gains from different materials, better ways of rolling out the materials, better ways of installing the generation capacity and linking it up to the existing grid. So it's a story that starts with government investment, crowding in private sector investment, learning by doing, benefiting from economies of scale, and we've seen a complete transformation so that now renewables outcompete fossil fuels in pretty much every market in the world. That's hugely important. The next challenge, though, is going to be bigger. It's going to be harder. If you think of an energy system, which starts with generation and ends with consumption, you have a real challenge. It's much easier to change something at the input side. So rather than having a coal-fired power plant, we have a wind farm, than it is to change everything that comes after that. And that's the next step, is to change the distribution network, to change the reception in homes, so that we can update the grid, so that we can electrify homes, buildings, transport. That requires changing the full energy system. It's going to require public investment to crowd in the private sector to deliver it.
Stephanie, one of the things actually we've invested in the L1 actually with Matthew is looking at different ways of measuring economic success. GDP, you're the economists on the screen, GDP doesn't really reflect the true picture. It doesn't take account of regional geographic differences, doesn't take account of inequality, etc. So we've been funding, and it was great to see Matthew on this call, Matthew and Cambridge on this project to look at different ways of measuring economic growth and success. Because I think if we reflect on the last, decade or 2 decades, whatever, in various countries, we've left a lot of people behind, and therefore that form of capitalism won't work. So we decided to invest in this project, and it's fascinating because, governments are going to have a different scorecard for what is success. And everybody has to be on the journey of success, not just a few. So it's been fascinating working with Matthew on it.
You talk about leaving people behind. I mean, one thing that worries me, and I don't know how much you're all seeing it more at the grassroots, but we're actually, some of the changes that we're talking about, which will be talked about in fora like this as great forms of productivity growth and great innovation, that we've had faster automation, we have working from home, which is enabling much more efficient labor approach to working techniques. But actually, that has left a lot of people in city centres stuck without jobs, because you've now moved, not just in the UK, obviously, I mean, in America as well, you see it's the unemployment rates much higher still in big cities, in part because people have now gone back into the suburbs and are not coming, or they're staying and living in the suburbs and working in the suburbs and not coming into town for their sandwiches and their everything else. So I just wonder, maybe not necessarily just on that, but if we're thinking about the sort of bumpy stage of the recovery that we clearly have ahead in different countries, what do we need to look out for? What are the pitfalls of that will put us on the wrong track when we're kind of grasping around with these supply shortages, but also trying to see some of these innovations that have come faster because of the pandemic?
I would have thought that we mustn't go back onto the same track. You talk about getting onto the right track. We've learnt so much, haven't we, through the pandemic? And as everyone was talking, I was thinking of my daughter who's just gone on to uni, and her friends asking me what should they do with their careers when they leave. And I realised that I'm not saying to them what I might have said 10 years ago, which is, join a big company. I'm saying, think about how you want to change things and think about setting up your own business, for example. I would never have suggested that to, the kids 10 years ago, as I say. And so I wonder whether we really do need to think even harder than we ever have about the right education for our children against a background of such a changed economic, social and corporate environment. I think the two are very discordant at the moment. And so to your question, Stephanie, around what should governments do, certainly in the UK, I feel we still have a pretty Victorian education system. And, we don't want a Victorian infrastructure. So how are we going to match those two things, I think, is really critical.
I think what we're also seeing from governments around the world, or certain governments, is a realization that the wealth gap has to be approached. I mean, in China, Xi recently said that capital is no longer for owners of the capital, it's for society. And he gave a speech in a Mao jacket, which, he goes back to the teachings of Chairman Mao, who said that we're going to use capitalism as a tool to get wealthy enough to then start giving the wealth back to the people. And in the United States, we've got Biden's Build Back Better program. Started out at $6.5 trillion. It's down to $3.5 trillion. As of yesterday, it might be a mere $2 trillion. But a lot of that is taxing capital and redistributing that to the middle and lower classes in the United States. And I think that's going to have a tremendous impact on investing going forward, because the returns are not going to be as great. I mean, they just can't be if you look at by definition. So, who do you invest in that kind of environment? And are there companies that, will do better than others? And, I think basically with all this climate talk, if you've got a low carbon solution and you want to start a business, to Jane Ann's point, I think you can do really well, because the demand for low carbon businesses is huge right now. I came across this Canadian company called Nexi, and they're in a very unglamorous industry. They make concrete, right? These prefab slabs so you can make buildings, walls, floors, whatever. But they can do it using 20% less carbon than traditional concrete. And they built a Starbucks in 6 days instead of 6 months. And the Starbucks building uses 40% less energy, right? So this company is 2.5 years old. It's private. The recent round of investing valued it at $1.2 billion, right? And 2.5 years. I mean, that's, I think in this world where, traditional returns are going to shrink because of government redistributing wealth, you've got to have a really innovative idea. You've got to tackle one of our big ESG issues. And if you can do that and start a business, to Jane Ann's point, I think our kids might have a better future.
I guess we shouldn't kid ourselves. I mean, that the amount of the return on wealth just in the last year and a half has been so significant. I don't think that, I think it would be hard to completely offset that with the changes that are currently being considered. And actually you're seeing in the UK, governments going the other way in terms of taxing wealth. But you're completely right, Brian, that's been very much part of the conversation. But it's interesting that President Biden's finding it so hard to even do that at a time when we just saw it was actually the Generation X. I saw some figures today to suggest that their net worth has gone up 50% in 1 year.
It keeps going up like that until it doesn't, right?
Can I just ask Brian a question, Stephanie? Do you think the life cycle of a company is getting shorter? There's so much entrepreneurship, so much innovation going on. And it doesn't matter where you look across the world, it's so exciting. And we were talking about it at L1 last week. But do you think, therefore, a life cycle of a company is getting shorter?
Oh, it absolutely is statistically. I mean, I think it's 25 years now for the ones that survive past the first few years. I mean, the mortality rate, obviously, for startups is very high. But Bezos talked about this, and he said most companies go out of business after 25 years. At the time, Amazon was 26, 27 years old. And he said what companies need to do is, he calls it his day one philosophy. And what he means by that is you have to run your company, whether it's big or small or new or old or whatever, as if it's the first day of a startup. In other words, you have to have that energy and that enthusiasm and that drive to keep surviving if you want a long life. And if you don't, Bezos says, it leads to decay and ultimately death. And it caused quite a ruffle, because he said Amazon was going to go out of business. But it's that kind of thinking that I think will allow Amazon to last a long time. And I think any company who takes that kind of entrepreneurial mindset and is really up to speed on all the ESG issues, I think they have a chance of lasting beyond the average time frame.
Yeah.
Do you see, just to go back a little bit to the question I had before, I mean, we're obviously facing these supply chain sort of snarl ups. We're having to focus on the fact that, focus more on supply than demand for the first time in a long time. And this is forcing businesses to make tough decisions about temporarily closing down places or hiring workers for a much higher, in an unsustainable rate. What's the best way of navigating those kind of challenges, the ones that we're going to see in the next 6 to 9 months, in a way that works also for the long term? None of you have the answer. That makes me much more worried.
Well, what I'm seeing is everyone's raising prices, right? They don't have inventory, and my local Audi dealership usually sells 400 cars a month. I was talking to the salesman there the other day, and that particular month, this summer, he had 150 cars to sell. So what do? You raise prices, all right? You're paying $2,000, $3,000, $4,000 more for the car this year than you would have a year or two ago. I think it's temporary. I think eventually the supply chains are going to right themselves. And in the meantime, I think companies are taking advantage of it, at least in the States, by raising prices quite dramatically. And that's why we have 5% inflation out there.
I mean, the other realm is automation, and so one of our companies, UiPath, which is on the NYSE as Path. I mean, that's a lot of what we invested in 7 years ago. Actually, one of their biggest early markets was Japan, where they have challenges with labor and not enough of a sort of a working population, and invested so much in automation. And I think we're seeing that companies are very actively, large companies, small companies, looking very much at what can they automate. And it's interesting where, there was a lot of kind of negativity against that when there was a lot of kind of thinking around, well, are people going to be out of jobs and what does this mean? And now it is a panacea and a solution, because we're facing such issues around productivity and labor. So again, thinking about it as a 10, 20 year, I mean, that automation will be critical. It impacts the bottom line. It allows a company to weather short-term, supply shocks like this, thinking so short-term and long-term. Again, back to the theme of our discussion here. So automation is a massive theme.
I guess, but the sheer pace of it, I know McKinsey Global Institute had an interesting study where they thought at least 5 years worth of automation has happened in the space of a couple of months in 2020. And there are transition costs to that, because we know not everyone's going to be able to go into the new jobs, even though they're there and needed. Joanna, you wanted to...
I wanted to make a quick point on this issue of supply chain issues that have been truly induced by COVID. There were halts in production that were due to the fact that people were in lockdown. There were also actually self-imposed controls by companies, because they didn't really know what was going to happen during COVID. So they cut costs, they cut capacity, they delayed and postponed capital spending investments that, of course, ultimately will impact their production capacity, because they were trying to preserve cash to potentially deal with adverse changes and impact to their business. These will probably clear itself out, but of course, we're currently in the midst of what I would describe as a recalibration in that supply chain. I also would very much agree with the points that Rishma said. This has absolutely accelerated investments in automation. This has also created a trend that perhaps not as spoken about, which is reshoring. A lot of companies have realized they couldn't be dependent on that single critical nerve point in a far remote location. So we're seeing also a reconfiguration of supply chains, whereby people are trying to create redundancy in the supply chain system and absolutely reshore pieces of their supply that are crucial and critical to their operations and business.
And is that already, we're going to run out of time in a minute, but I don't know if someone wants to come in. I mean, if we are seeing that kind of reorientation of supply chains, there's a sort of nostalgic or sort of sentimental way of viewing that people would say, well, it's closer to home, therefore it's more sustainable and is going to be better for community. You know, how true is that? I mean, Matthew, you can pour cold water on that. Should we be concerned about regionalization or nationalization of supply chains?
So for certain sectors, it's absolutely necessary. If you want to have resilience in the sector, you must have local production. Agriculture, for instance. If you want a secure food supply, you have to have some local production capacity. On the other hand, trade has brought about the greatest advancements in human welfare that our species has ever seen. It has facilitated the sharing of ideas and culture and cuisine and people all across the world, and I'm all for it.
But I do think, Stephanie, there's going to have to, as we see more and more automation, as we see more and more innovation and disruption, we're going to have to, there's an element or a part of the workforce that will have to be retooled and reskilled. And that will require some state intervention, because otherwise there'll be social problems, because there'll be an element of the population that is jobless and in trouble. So I do think reskilling, retooling, whatever description you want to, it's going to be very fundamental over the next few years, because the automation is going to speed up.
And I think that it's probably a good note to end on, but it's certainly, it feels like a challenge that governments are only just sort of getting their heads around. I mean, if we look at the last 20 years, the thing that governments have generally failed to do is to bring those held back or underskilled groups along. Certainly ones who lost out in previous technological cycles and fallouts in manufacturing have not been well served by the training policies of the last few years. So I hope that we're seeing a different kind of approach, and maybe one that businesses and investors will be helping to incentivize. So we've had a great discussion. It is now over. So thank you to Letter One and to Lord Davies for helping to make this panel happen, and to all of the speakers: Rishma Sohoni, Johanna Rocha Scarf, Matthew Agarwala, Dame Jane Ann Gadia, and Brian Dumaine. Thank you very much.
Thank you very much.
Thank you.
Thank you very much, all.
Thank you.
Thank you.
Thank you.
Bye.
Bye.
Bye-bye.
Thank you all for joining us at Bloomberg Invest Global. We hope you enjoy the conversations. And thanks again to all of our speakers for such a wonderful program. And thank you to our presenting sponsor in the U.S., Invesco QQQ, and our presenting sponsors, Abu Dhabi Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, Letter One, Qatar Financial Center, and our supporting sponsor, CMC Markets Connect, for making this virtual summit possible. If you'd like more information from our sponsors, please visit the Resources tab on your screen. And most of all, thank you for being such an engaged audience. I'm Shonali Bassick with Bloomberg News. Thank you for watching.